Here are your top stories. Fed officials anticipate more rate hikes to curb inflation, though most back a slower pace of tightening. President Biden says he does not see Vladimir Putin using nuclear weapons despite suspending involvement in an arms treaty. Plus, we speak to the CEOs of Anglo American and WPP as they report earnings. We're going to watch the shares as they open.
Look at that, Tom. If you look at futures, they're actually gaining on the back of a bit of support also from Asia. So it does look like we have a risk-on sentiment. Overall, I wouldn't, write home about it because we did have 4 days of declines, but we had a nice push from NVIDIA, and that stock was up 9% yesterday.
Yeah, to your point, how much conviction really is there in the risk-on mood that we are seeing? But you're right, we're starting to see evidence that you're going to be snapping 4 days of losses stateside. NVIDIA, a key catalyst in the NASDAQ futures that we'll look at shortly. Of course, they've upgraded their guidance. They've got a pretty bullish forecast, and we'll be checking in on some of the European stock makers as well on the back of that news from NVIDIA. The FTSE 100 currently down 0.2%. We're looking ahead in the Eurozone to inflation data out later this morning as well to flesh out the picture around the health of this European economy. The Spanish IBEX currently up 12 points, a gain of 0.1%. Let's switch it over then, have a look at how the futures are shaping up stateside with a particular focus on the tech-heavy NASDAQ, given that bullish forecast by NVIDIA. They think there's going to be sales demand growth underpinned by artificial intelligence and the semiconductors, the chips that they're designing for those purposes, and that's broadly lifted the NASDAQ futures, currently gaining 0.7%. Euro dollar 106, a gain there of about 0.1%. Yes, the dollar is softer after the gains that we saw yesterday. 4.69 on the 2-year. Brent at $80 a barrel, a gain of 0.4% after the longest run of losses for oil year to date, so far this year at least. Fran.
Tom, let's get straight to our markets reporter, Valerie Teitel. Good morning, Valerie. You're looking at the Fed minutes, and as John Authers puts it, 3 weeks actually is a long time in markets.
Look, a lot of the key takeaways focused on the chat around the 50 basis point hike. We heard from Messer and Bullard last week that they supported it. Turns out they didn't really have a lot of friends in the FOMC about that. There was also no mention of a pause, Francine. There wasn't even a mention of the word disinflation, which Powell used ad nauseum in that Q&A. The emphasis instead was on maintaining this restrictive policy stance for longer. They also discussed the upside risk to the inflation outlook, that remaining key to policy. There was no discussion about the downside risk to the inflation outlook. Remember, going into these minutes, we had a string of soft CPI prints, but they instead still are focusing on the upside risk. Now, these two taken together might suggest that there is room for those dots to shift higher, their rate forecast to shift higher. But I want to show you in the next chart what we've priced in this month of February. This month of February alone has seen a 50 basis point rise in that Fed terminal rate. This is pricing from Fed Funds Futures. Shifted 50 basis points higher in February to nearly 5.4%. One could assume that the market is already pricing a shift higher in those dots that we get on March 22nd.
Okay, Valerie Teitel breaking down the Fed minutes for us, our markets reporter. Thank you. For more, let's bring in Bloomberg's Christine Aquino. Christine, let's start then there with the reaction to these Fed minutes. A terminal rate then, as Valerie was highlighting for us, that's shifted just in the face of about 30 days in terms of the market expectations from 4.9% to close to 5.4%. The implications then for these equity markets?
Well, Tom, I think with initially quite a soft equity market, we saw that basis that there's potentially going to be less of rate.
Okay, it seems we have a mic issue with Christine, so we'll connect you. We'll make sure that the tech is fixed on that front. But
Let's look at futures.
Let's check in on the futures then.
The point actually with the minutes, right, overall, is that they're extremely interesting as always, but they probably matter less than usual as they cover a meeting held before the slew of data that changed market perception.
Absolutely. That gangbusters number in terms of the non-farm payrolls, 517,000, and then of course a higher than expected CPI print, all coming up after, as Fren was flagging, those Fed minutes. By the way, talking today, more data out of the US in terms of jobless claims that we've been looking for, and the GDP print out of the US. We're reconnected with Christina Kane, which is fantastic news this Thursday morning. Christine, pick up then with the market reaction to the markets now pricing in, the equity market reaction to the pricing in now of a terminal rate potentially 5.4% by July of this year.
Well, Tom, I think, again, like we saw that shift from that January rally to a bit of a panic in February, right? When the realization that Fed officials are ready to deliver more rate hikes. They've been emphasizing a higher peak in the Fed terminal rate, which came as quite a shock to markets who were hoping that maybe they were nearing a pause. We were kind of going to get that no landing scenario that was really gaining traction over the last couple of weeks. But, you know, the last few commentaries that we've heard from Fed officials kind of pouring cold water on that idea. But I think now that we've gotten to this terminal rate pricing of 5.4%, again, it's notable because it's even higher than some of the more bullish estimates out there from Fed officials. I think Bullard said his was around a 5.375%. I think now we've kind of recalibrated those expectations. So ironically, after the minutes yesterday, where there was a lot of anticipation for hawkish Fed commentary, today we're seeing a bit of a comeback rally just because, you know, we're kind of moving past that now.
Christina, the thing is that with the blow-up numbers, I wonder whether it just changes the narrative completely, right? So we have a pretty good understanding about the reactive function of the Fed is if inflation doesn't come down, they keep on hiking. So is it all about what inflation does more than what some of these Fed officials are telling us?
Well, it's definitely inflation, Francie. I mean, even the Fed officials who were kind of coming out more hawkish are ultimately saying that it will be data dependent. It depends on what we're seeing, not only on the inflation side, but on the labor market side as well. And I think what's giving the Fed really a lot of confidence to come out a bit more hawkish is the fact that we have seen the labor market repeatedly showing signs that it is holding up well. It's staying robust despite the fact that we've seen numerous Fed rate hikes now. And, you know, until I think we see something kind of substantial that's breaking there, at least signs that it's starting to break, I think the Fed's really going to have a lot of room to play here.
And on the data front, jobless claims later today, as I mentioned, US GDP, the importance of that data, do we expect any big moves around that?
Well, Tom, I think it will just kind of add marginally to the narrative that markets are dealing with right now, which is essentially that they're coming around to the idea that inflation is still persistent. The Fed is going to try and fight that. And then on the labor market side, it's staying robust. And so, you know, if the jobless claims number comes in quite as expected or nearly in line, no big surprises, then I think that just kind of continues that narrative. Markets have done a lot to kind of price in the risk of a higher terminal rate. And this is why we've seen quite a soggy February for the most part. But now that I think, you know, those expectations are starting to become aligned, looks like the reaction is a little bit more subdued in markets.
Chrissy, at the same time, so chip maker NVIDIA issued a pretty bullish outlook. And actually, we also have the same from Rolls-Royce. How are companies keeping up and actually with earnings and also beating expectations?
Yeah, well, kind of interesting, Francine, because I think we've seen quite some optimism from the recent earnings results that we've seen. Again, you know, NVIDIA, Rolls-Royce, that's quite promising in terms of the demand story. We were quite worried about that when earlier on we were hearing from some of the tech companies kind of painting a more negative picture of demand, right? But now that we're hearing more from the industrials and industry, we're seeing kind of more signs of green shoots in terms of demand, which is really quite promising. And then just broadly, we've seen also the trend of companies giving back to investors via buybacks and dividends. Now, that's quite interesting just because there's quite a contrast there between the companies are kind of giving back to investors and shareholders, but then investors not necessarily being convinced over the longer term outlook. We've seen, especially in the banking sector, quite a number of banks kind of announcing sizable buybacks. In the UK alone, I think we've seen about 4 billion announced very recently. recently, but all of those bank shares fell in the aftermath. And so that kind of also tells you, while there are green shoots at the moment in terms of the demand story, investors are still quite worried about the medium-term economic outlook.
And the macro backdrop is clearly part of that mix. We're going to get Eurozone inflation data out later this morning. Of course, the ECB has been relatively hawkish. We saw the services data, services PMI out earlier this week being relatively robust here in Europe. In terms of the inflation picture and the strength of this European economy, where do things stand and how are markets moving and adjusting to that?
Well, I think, Tom, markets are also realizing that perhaps there's some underappreciated growth that's coming out of the Eurozone and the European economy. And, you know, things really have been turning out more positive in terms of the hard data side, despite still quite negative sentiment on the ground. And we were talking about this yesterday in a context of some comments from the Bank of France Governor Villeroy saying that maybe markets are overreacting in terms of pricing in those rate hikes. He was kind of, I think, providing a counter argument to what we heard from Isabel Schnabel last week, who was saying that maybe markets are underestimating the potential for rate hikes. A little bit of back and forth there from ECB officials, but I think what's kind of giving rise to this debate is the idea that the European economy is holding up a lot better than expected. The milder weather, better than expected data coming out recently. That's all kind of helping investors realize that maybe there's more growth in Europe than we realize.
Yeah. All right, Christine, thank you so much. Christina Kino there with some of your market moves. And then we have also a share price on the move with Rolls-Royce.
Yeah, Rolls-Royce soaring on the back of a beat across the board for its earnings. Let's check in on the share price then. The last time I had a look, it was up about 20%. I'm trying to get it up on the terminal, but the background in terms of the data, in terms of the earnings, is this. A beat across the board, as I said, in terms of full-year earnings, topping expectations on all metrics. Rolls-Royce, of course, it's a manufacturer of largely aircraft engines. Guidance equally robust, according to the analysts. You have the likes of Barclays, they're overweight on their stock, saying the metrics were all better than expected. Jefferies also coming out saying the full-year results are strong, with operating profit of around 42% ahead of consensus. So that's the redhead, Rolls-Royce soaring on the back of very solid guidance and a beat on the earnings front.
Coming up, Anglo-American reports a small beat, but the global economic slowdown still impacting the miners. So we'll speak to the chief executive shortly. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority. Be
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. Now, Anglo-American has posted a slight beat on earnings per share for the year. That's despite joining its peers and seeing an overall drop in profit. The mining giant also reported a $1.7 billion write-down on a UK fertiliser operation. We're joined now, very pleased to say, by Duncan Wanblad, CEO of Anglo-American. Duncan, good morning. Thank you for joining us this morning and to talk through these results. There's a lot to unpack with you. Let's start with some of the production issues that the company has faced over 2022, whether that's in South Africa, Australia with the flooding there, or indeed South America. Do you see those production issues continuing this year? What is your level of confidence that you'll be able to hit this year's targets?
Morning, Tom. Thanks for having me. Yes, no, absolutely. A very volatile year in 2022. A lot of it led by the fact that coming out of 2 years of COVID, mines were in a position where they had kind of got out of shape. So we needed to reshape that. That all happened during the course of last year. But of course, we had the confluence of some extreme weather events throughout the year, particularly in the first half of the year. Much of that's gone away. How do you deal with this stuff now in the future? I think you just have to recognize that a lot of this is now probably a new normal, and so we have to take that into consideration as we plan for the business going forward. Very happy to say that having got on top of that in the second half of the year, first bit of this year seems to have stabilized as our expectations are.
So when you look at your operations going forward, given what you've just said, how do you make them more resilient?
Yeah, a number of things that you have to do. So just from a water perspective, for instance, I think we just have to ensure that our ability to evacuate water from mines, store water, and get water outside of the runoff areas into mining operations is a lot more robust than it has been in the past. And I think we have to look at minimizing our footprints, whether that's on a land use point of view, an air emissions point of view, and all of these sorts of things go to making the business more robust.
Duncan, clearly there are concerns, macroeconomic concerns globally around the slowdown, around potential recession. To what extent do you think the China reopening, the demand from China, will offset some of that slower growth?
Oh, I'm very positive about China reopening. I think we saw a lot of pressure in the economy over the last year or so as a result of China being locked down. Now that that's starting to open up, a lot more optimistic about the fact that there will be a bit more stimulus, and I think that that's good for prices. They'll hold up a little bit more given where we are today, and of course, you know, we are exposed to China, not as much as some of our peers, but China is a really important market for us as it is for the global economy.
You've also, Duncan, had a $1.7 billion write-down, and this is because of fertilizer, something that you bought here in the UK. If you had known back then what you knew now, would you still have bought it?
Oh, absolutely, we still would have bought it, Francine. I mean, so what we were really compelled by on this particular project were two things, really. One is the market that this is going to serve and the underlying fundamentals of that market, so growth in food and food security, and the quality of crop nutrition are the key elements of this particular product. And then, of course, this resource is so unique. It is a one of a kind in terms of its size and shape and all of the elements that are associated with that. So we will be able to bring some very, very profitable fertilizer onto the market, an organic fertilizer that does a lot more than just better crop yields, but has some great sustainability credits to it too.
Yeah, so we're talking about the Woodsmith mine here in the UK. 2027 is when you expect production to start there. Poly 4 is the potash that's coming out of that mine. It is relatively new in terms of its potential. How big do you think the market is?
Well, it's first of all, it's not a potash. It has potash in it, so there are 4 key nutrients of the 6 major nutrients that are embedded in Poly 4. You know, right now there is a similar product in the market, very, very small volumes, We will take this project to 5 million tons of product per annum by 2030, and then from 2030, depending on how we can develop the market, we'll grow it to around 13 million tons per annum.
How much will that cost? So I think you're saying it will cost about $4 billion to get production 2027. How confident are you about that? And then how do you get it to 13 million tons a year?
Well, this is one of these projects where it's going to be in development for some time. So we know that it's a deep underground mine, and there's a very large portion of this project per se today that is in about 25 to 35% pre-feasibility study. So that's going to be studied out, engineered properly before we can put the capital costs to that. We are confident that in terms of the sink of the core infrastructure, which is the tunnel and the shafts, that we'll be spending in the order of $1 billion a year between now and 2027 when we start the ramp up to 5 million tons. And what will happen after that is, having set it up right in the first instance, much lower capital intensity to get it from 5 to 13.
Duncan, just briefly before we let you go, a slight miss on the dividend. Is the era of bumper shareholder returns within this industry over, at least for now?
Tom, great dividend actually, and exactly in line with our policy, which was a 40% payout ratio. And I think that that's the way we have to think about it. Very balanced view of returns to shareholders. And to the extent that we can't invest in anything, of course, we would look at improving dividends to shareholders. But, you know, we're still growing the company, and I think that it's a very good dividend in the context of where we are.
Thank you so much for joining us. Duncan Wanblad there, the Chief Executive Officer of Anglo American. Now, coming up, we'll have plenty more, of course, on some of the companies that reported earnings. We also talk about President Biden saying Vladimir Putin has made the world less safe by suspending participation in a nuclear treaty. A little bit later on, we also speak to the NATO Secretary General, Mr. Jens Stoltenberg. We have all of the details. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. We are 22 minutes into the European trading day. Cautious optimism across European stocks, gains of 0.2%, and the FTSE 100 is down 17 points so far. You're seeing strength over in France on the CAC and the DAX. Futures in the US also higher, up 0.5% on the S&P E-minis. We have jobless claims coming out of the US and GDP data later today. But again, broadly, risk on, dollar lower this morning. Francine.
Now, President Biden says Vladimir Putin has made the world less safe by suspending participation in a nuclear treaty. But the U.S. president does not believe it signals the Russian leader will use the weapons.
I've not seen anything, we've not seen anything where there's a change in his posture and what they're doing. The idea that somehow this means they're thinking of using nuclear weapons, international continental ballistic missiles, there's no evidence of that.
Now, for more, let's bring in Bloomberg's senior editor in Singapore, Bill Ferry. So, Bill, if you look at where we are right now, tomorrow marks 12 months since Russia's invasion of Ukraine. Are we any closer to peace?
Well, there's no sign that there's any end to this conflict. We have heard from the Chinese that they are going to put forward what they're calling a peace proposal. I think that's being viewed very skeptically in the U.S. and Europe, partly because China is seen as not really having distanced itself from Russia so far. So they're not really seen as an impartial player in this, but we're all waiting to see what those details are. And it comes right after the Chinese Foreign Minister Wang Yi visited Moscow and met personally with President Putin.
Rock solid is how he described that relationship, Wang Yi, with the Russians. And on that point, was there more that came out of that meeting that gives more clarity on Beijing's stance? And indeed, are we hearing any more from the US about their concerns about China considering, as they describe it, China considering supplying weapons to Russia?
Well, the warning has gone out from the U.S. State Department that says they're watching very carefully. There is some debate going on about how much intelligence the U.S. should show to back up its assertion. China has drawn what it says is essentially a red line in terms of nuclear action. As I said, we're still waiting to see what kind of details come out on this peace plan. But, you know, talking about being 1 year into this war, there's very little sign of any sort of a deal being reached anytime soon.
Okay, Bloomberg's senior editor, Bill Ferry's on the latest, and particularly with that visit by Wang Yi to Moscow. Bloomberg also reporting that support within Russia for the conflict is actually pretty solid. Okay, let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. A Washington Post report says Meta is preparing for thousands of job cuts beyond the 13% of its workforce fired in November. Separately, Bloomberg has learned Italy is investigating the Facebook parent for an alleged 870 million euros in unpaid VAT. Meta says it disagrees with the idea that providing access to online platforms should attract the tax. Nvidia shares have jumped in US late trade after it gave a bullish revenue outlook for the current quarter, suggesting its push into artificial intelligence processors is helping offset sluggish demand for PC chips. The company has moved from a focus on graphics processors into a strong position in the growing market for AI hardware. Intel has slashed its dividend by 2/3 to the lowest level in 16 years. The world's biggest maker of computer processors says the decision is designed to create long-term value. In its earnings report last month, Intel forecast one of the worst quarters in its history as a slowdown in PC sales ravages the semiconductor industry. That's your Bloomberg Business Flash. Tom, Francine.
Alice, thanks so much. Coming up, WPP shares surge as the ad giant forecast sales will rise more than expected. We'll be joined by the chief executive, Mark Reed. That's coming up next. Also, a chat, of course, on AI and ChatGPT. This is Bloomberg.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How about the Instagram? Can you think about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Fed officials anticipate more rate hikes to curb inflation, though most back a slower pace of tightening. President Biden says he doesn't see Vladimir Putin using nuclear weapons despite suspending involvement in an arms treaty. Plus, a big day for earnings. We speak with the chief executive of advertising giant WPP shortly as their shares jump after reporting. And Tom, if you look at the markets, a bit of Fed chatter, but really a lot of focus on NVIDIA.
Yeah, NVIDIA certainly a catalyst coming through with some very bullish guidance, and you're seeing the NASDAQ higher on the back of that. Semiconductors certainly getting a lift. Yes, there were the Fed minutes, but of course those were minutes that came out, or at least this was a meeting before the bumper jobs data. Nonetheless, Venram on our MLive team saying, look, the clear takeaway from these Fed minutes was that this is a Federal Reserve far more focused on the inflation risks and far less concerned about the impact on growth of that US economy. Across the European benchmark, currently gains of 0.3%. We are risk on moderately. The DAX gaining 0.5%. Pretty strong session over in Germany, but the FTSE 100 down 0.2%, off by 17 points. Basic resources are dragged there, despite the fact that you have some earnings coming through and some stock jumps from the likes of WPP and Rolls-Royce also soaring. Let's switch over and see how things are playing out across these sectors. Technology, as we were saying, the NVIDIA play, partly a mix here, up 1.5%. Also gains from autos and parts, gains of more than 1%. You have, what, 6 sectors currently in the red so far, 30 minutes into the trading session. Healthcare, of course, that tilt to some of the safer parts of these equity markets, taking a bit of it, down 0.4%. Basic resources, as I mentioned, also off. You've got iron ore lower. Brent, though, coming back after some losses for oil. But it's iron ore that's playing in the basic resources space sector, currently down 0.3%. Fran.
Tom, we're also looking at live pictures of Janet Yellen actually speaking at a press conference at the G20 in Bengaluru, India. Now, she says the global economy is in a better place today than many predicted months ago. This is, once again, as you can see on screen, by the U.S. Treasury Secretary Janet Yellen. She says the challenges, though, we face are real. The future, she says, is always uncertain, but the outlook has improved since we gathered in the fall. Remember, her comments come just weeks after the IMF said it was a turning point for the global economy and actually raised their growth forecast for the first time in a year. Now, the world's largest ad agency by revenue, WPP, has surged this morning after forecasting sales will rise more than analysts had expected in the coming year. Now, the firm's revenue growth beat estimates as it won $5.9 billion of new business in 2022 from companies like Audible, SC Johnson, and Verizon. Well, joining us now is the Chief Executive Officer of WPP. He's Mark Reed. Mark, thank you so much for joining us. Now, for the moment, your shares are actually flying, gaining more than 4%. Are you surprised that a lot of your customers keep on spending, given the outlook and recessionary pressures, though, out there?
Yeah, look, I think there's some surprise. Certainly, there's some fears back October, November last year, and the consensus swap was -1. This year, we're now saying it's going to be 3 to 5. But I've never been of a view that this year would be a catastrophe. I think that clients recognise the value of marketing, recognise the value of advertising. A lot of that, I think, has come through from COVID when they realised the importance of communicating with their customers. But we live in a world that's much more complicated, and we live in a world with new opportunities. Netflix taking advertising, the growth in TikTok, the explosion of retail media. Amazon is now one of the world's largest advertising platforms, and in the last 3 years. I think clients, understand they have to communicate with customers, particularly the period of inflation. I was interested to see those comments from Janet Lynn. I think the economy is in a better place than perhaps we had feared, and we shouldn't catastrophize what will happen this year. So I think 3 to 5% growth for us is a pretty respectable target for the year.
So Mark, on that point around your conversations with big clients in particular, are you getting a sense of caution, a sense of optimism? Are you seeing any of them cutting budgets at this point?
Certainly, I don't think, from time to time, clients cut budgets, but I think there's a lot more resilience than we expected. I think talking to chief executives privately at the end of last year, they were much more confident than perhaps they were, in public or when they appeared on your program, if you like. And I think, that sort of quiet confidence, I think, continues into this year. And consumers continue to spend, and while consumers continue to spend, clients continue to invest. And I think the other point to make is a lot of clients are facing, volume decline, but price rises. And I think they realize the need to support their brands through investment in marketing and advertising.
You also have a relatively big exposure to China, Mark. How do you see that going on? Clients picking up spending, or are they still very cautious ahead of the full reopening?
Well, when I talk to people in China, they're a lot more optimistic. China's an important part of our business. It's 5% of our business with about 9,000 people there. For us, we had a good Q1 last year, actually. So I think we'll see the benefit of China feed through into our numbers Q2, Q3, Q4. But I think we'll see chief executives are going to start visiting China again this year, and they're going to find a very changed economy, much greater use of digital technology than perhaps we see here in the West, an explosion of innovation. There are now 300 EV companies in China. China actually makes more EVs than America produces cars. And so, I encourage people to get over there and see what's happening. And I think the economy opening up will help global growth and will certainly help our numbers for the year overall.
Mark, would love to get your views on M&A and potential acquisitions. Some of your competitors, I'm thinking of Publicis, spending billions acquiring businesses around marketing, tech, and data. Are there any assets that you're looking at? Are you looking at making any deals to kind of close the gap on that front?
Well, I don't think we necessarily have a gap to close, but we've spent about £400 million in our budget for acquisitions over the course of this year, and like last year, we're going to focus on the areas of data, e-commerce, technology, analytics. We're really investing heavily as a company in AI and artificial intelligence. There's no doubt that ChatGPT's captured the world's imagination this week, but it's certainly, or this past few weeks, but it's certainly been an area where we've been investing the last 2 to 3 years. We acquired a company, Satalia, based in London. We have really strong AI companies here in London. So that's a big.
But on AI, how disruptive can this be? If we stop actually using our browsers to search for search engines, then you have to rethink the way you sell things and you get onto websites. So how are you using ChatGPT or AI to create advertising right now?
Well, look, we're using it in our media business to target consumers. We're using it in our creative business to help generate ideas. We're using it to produce a tremendous amount of work as well. So I think it's going to be fundamentally disruptive. As for search, I think it's too easy to say. AI or ChatGPT is only as accurate as the database it uses, and we all know the internet is not totally accurate source of information. So, it's a killer application for my son's homework. Whether it's a killer application overall, I'm not entirely sure.
Now we can explain all of your son's straight A's, Mark. Look, let's look back to one of your first answers. And if only. And you talk. I'm sure that is the case. You talked about TikTok. Talk to us about the importance. How important is TikTok? Is it more important for your business now than Meta?
No, it's not, let's say, more important from a volume perspective. But I certainly think, clients want to be where the action is. And a lot of action or a lot of growth is now on TikTok. And particularly clients looking to work with influencers. It's a really interesting medium. It's not a sort of medium where you can take a 10 or 15 second ad and just run it. You really got to understand how it works. And you've got to be really careful about where your brand appears and who you reach. There's a lot of young audiences on TikTok, and so clients need a lot of advice on, how to protect themselves and how to protect, consumers on TikTok. So there's a tremendous amount of interest, I would say.
What's your favorite, Mark, social media platform? I know that there was Clubhouse, that's been and gone. I feel like, is there a next big thing that you're looking at?
No, I don't think there's any next big thing. I mean, it's interesting how they're all used for different things. LinkedIn is a business network. I think that Twitter seems to be a lot more stable the last few months than perhaps it was towards the end of last year, and it's coming back to some extent. I think clients will start to look about how they can come back onto Twitter as the course of the year things remain as they are. But they're all used for different things. I try not to spend too much time on it. We have got a job to do.
Okay, Mark Reed, so far you're doing a pretty good job, at least the earnings suggest. So Mark Reed, Chief Executive Officer at WPP, on the earnings and some homework tips for some of our younger viewers, maybe. Okay, let's check in on some of the individual stocks on the move at the open. ST Micro, we're looking at this because, of course, there's a read across from what we heard from NVIDIA, a pretty bullish outlook from that chip company, particularly, and we're just talking about AI there with Mark Reed, on the demand for chips that can be used within AI going forward. ST Micro then getting a lift on the back of the optimism from NVIDIA, up 2.5%. Rolls-Royce is the engine maker, of course, coming out with some earnings that the analysts have regarded, at least reacted to very positively indeed, and as have investors. Currently 18% gain there for Rolls-Royce. It was a beat across the board, and then they raised their guidance. Eni, the energy company over in Italy, of course, down 0.9%. Fran.
Coming up, a Bloomberg economics analysis shows that the sanctions placed on Russia a year ago have not had the impact the West initially hoped for. We'll bring you the latest findings on the impact the war in Ukraine is having on the Russian economy. We have two interviews, of course, coming up that you don't want to miss. First of all, we speak to the Secretary General of NATO, Mr. Stoltenberg. That's at 9:30 a.m. And also coming up at 9 o'clock, we speak with Bruce Flatt of Brookfield. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The moment news breaks, no one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open. We are 43 minutes into the European trading day. You're seeing gains of 0.3% optimism across these equity markets. Looking through the Fed minutes for now, at least, it seems to focus on the earnings picture. Strong guidance from NVIDIA. We've had beats from the likes of WPP and Rolls-Royce soaring as well on the back of some very strong guidance. Futures in the US tied to that NVIDIA picture, gaining. NASDAQ futures up close to a full percentage point. Briefly touching on oil, you're seeing a bit of a pop there for Brent, up 0.8%, trading at $81 a barrel.
So, Tom, what impact have unprecedented Western sanctions had on Russia's economy? Now, the latest Bloomberg analysis shows the country's downturn last year was a fraction of the almost 10% collapse that was predicted. So joining us for more on all of this, Louise Dixon, Reichstadt Energy Head of Oil Analytics, and Alexander Isakov, Russia economist at Bloomberg Economics. So thank you both for joining us. Alexander, let's start with you. What did Russia do to try and mitigate some of the sanctions? Was this 5-10 years in the planning?
I think there are two things that Russia done. First of all, they've built pretty large fiscal buffers. They've accumulated around 600 billion in the international reserves, and while most of that has been frozen, they continue to rely on the Chinese yuan savings to finance any shortfalls in export revenues. And second of all, Russia did what it has been doing for many years now. They didn't retaliate, so they mostly just agreed to the sanctions-induced discounts on its oil and continued to pump as much as they'd done before the sanctions.
And Louise, let's bring you in at this point, because pumping they have been doing, exporting. In fact, Russian oil exports are essentially the same level they were before the invasion. Of course, China, India are a major factor there. Does that continue, do you think, in the months ahead, Louise?
Yeah, well, we said this at Reset Energy the day of the invasion, and I guess it sort of might bear some repeating now 1 year later, but the impact is not as exaggerated as some market participants had either hoped or wanted it to be. And it's still about, in terms on the supply side, just about a 1 million barrel per day impact. So our view hasn't really changed on this. And in terms of sort of link between Russia's upstream capabilities and finding new markets, yes, a lot of this depends on just how low the G7 can really set the price cap, but more so it matters. But more so it matters
Louise,
on sort of, yeah.
Yeah, what have you found most surprising, actually, in the last 12 months? Is it that Russia has been able to sell and divert some of the oil exports to countries further afield to the east? Or has it been that actually Europe has been able to make and mend without Russian oil and gas?
I think that both are equally impressive. I think that what the market was not really pricing in, especially, was that Russia would actually be able to find enough tanker capacity to expand and to deepen sort of relationships and exports to other markets such as India and China. But currently, actually, we still see that there's a bit of spare capacity in this tanker fleet that Russia has been able to build. Therefore, we could actually even see, despite sort of these upstream limitations, we could still see an uptick rather in some crude exports still to come.
Okay, so crude exports could actually further increase from here despite the price caps and the sanctions imposed. Alexander, let's bring it back to you then. Does that give the Russian economy further resilience again in the year ahead, or is there a breaking point coming? Foreign direct investment, of course, has collapsed, hasn't it?
Yes, exactly. I think this is the most important part, to distinguish between resilience and growth. Russia is very good at resilience, but not very good at growth. The key donors of technology and real investment into Russian country, into Russia, used to be Western countries. If you look at the Russian current partners, they may substitute in terms of imports and provide some kind of technology, but they will not invest in the Russian economy. This leads us to expect Russia will not grow more than 1% in the next 5-10 years, and will be a $200 billion smaller country by 2026 compared to where it would have been absent sanctions and the war.
So, Alexander, what does that mean in terms of how much they can fund this war for?
my kind of view here is that if you look at wars in general, it's almost like a domestic sector of the economy, and it's like a services sector. So Russia is a big country, and I think very committed to this thing. And my feeling is that if there are any binds on Russian ability to wage this war, they don't come from economics.
Louise, China clearly a big factor here in terms of picking up some of the slack. And there's a lot of debate amongst energy analysts as to how much and how strong that demand is going to be from China through the next 12 to 24 months. What is your call on just how much demand input is going to come through from that economy?
Yeah, no, Tom, I think you're absolutely correct there, that really understanding just how bullish a signal China is going to be for oil markets in 2023 is absolutely going to hold the key to pricing and markets. So what we're seeing now in China after the lifting of COVID restrictions, we are seeing some upward momentum, especially in road, aviation, just how much people are driving, how much they're flying. However, the big distinction there is that while domestic aviation has returned to pre-COVID-19, normal levels, we're still seeing a big gap in the international big haul flights. So that still leaves a big gaping hole sort of in the jet fuel demand in China. And until that's reconciled, we can't really speak about a full comeback in Chinese oil demand.
Okay, really interesting. So looking at the long haul flights and whether or not that indeed proves something of a comeback as the domestic aviation industry certainly picks up pace. Louise Dixon, Rystad Energy Head of Oil Analytics, and Alexander Isakov from Bloomberg Economics with a focus there on the so far relative resilience of the Russian economy. Thank you both very much indeed.
Now, coming up shortly, we speak exclusively to the Chief Executive Officer of Brookfield Asset Management. Don't miss that conversation with Bruce Flatt. That's at 9 a.m. UK time in 10 minutes from now. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Welcome back to the Open. We are 53 minutes into the European trading day. The FTSE 100 is the laggard so far, 52 minutes into your trading day, down 0.2, close to 0.3%. Every other major index, though, in Europe gaining this morning. The benchmark is up 0.2%, and the futures are solidly higher in the US. Certainly, NVIDIA chipping in. See what I'm doing there to the NASDAQ futures, up 0.9%. That's a brief perk at your futures. We'll come back to the markets shortly. Let's take a look at some of the other key things we are watching out for across these markets today. 10 a.m. UK time, we're going to get a final print of Euro area CPI. Important, of course, for the direction of the ECB and the hawks there. Important to mention the preliminary print used a, quote, unpublished German estimate. So this final print could see big revisions. At 10:45, BOE Deputy Governor John Cunliffe is due to speak at a meeting of central bank deputies. The next meeting, of course, for the BOE in March, and that decision remains up in the air. This afternoon at 1:30, we're going to get a second reading of US GDP data. Also, and the importance of the labour market here, of course, at 1:30 UK time, the latest US initial jobless claims numbers. And then, 7 p.m. Atlanta, Fed President Raphael Bostic is due to speak at an event in Atlanta. We had the Fed minutes out yesterday, of course. The key takeaway, really, that the focus for these Fed officials remains on inflation rather than any concerns about the health of the US economy and growth, at least at this point. Let's get to the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Federal Reserve officials anticipate more rate hikes to curb inflation, though most support slowing down the pace. Minutes from the Fed's meeting 3 weeks ago say almost all officials agreed to an increase of 25 basis points. Only a few were said to have supported a 50-point hike. President Putin says he's waiting for his Chinese counterpart to visit Moscow. Xi Jinping is reportedly preparing for a trip in April or May to push for multi-party peace talks. China's top diplomat Wang Yi met with Putin in Moscow, calling the relationship between the two countries solid as a mountain. Rishi Sunak has hinted he's seeking legal changes to the Northern Ireland Protocol, something the EU has previously said it's opposed to. The UK PM was responding to criticism of his proposed trade agreement from the leader of Northern Ireland's main unionist party. Two prominent economists, meanwhile, have told Bloomberg a deal on the issue would unleash tens of billions of pounds in business investment for the UK. G20 host India is said to be seeking to avoid using the word war in any joint statement which refers to Russia's invasion of Ukraine. That would diverge from a consensus reached by leaders in Bali last November. A source says Indian officials would prefer using words like crisis. We're told the hosts are also concerned that plans for additional sanctions on Russia will draw attention from other G20 priorities. Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alice Atkins, and this is Bloomberg. Tom.
Alice Atkins, thank you. And on that G20 story, the US is very clear, of course, that this is indeed a war that Russia is perpetrating in Ukraine. And we have the Treasury Secretary, Janet Yellen, is in and at the G20, attending a couple of lines crossing from a speech earlier from Janet Yellen, saying that sanctions had a significant effect on Russia. Also, in terms of potential support from China to Russia, providing material support to Russia is a serious concern, Janet Yellen there. A couple of stocks on the move for us today. A big beat in terms of Rolls-Royce. Guidance there also lifted. That stock rallying. Any in focus for us as well today. WPP is also up. It was a beat for that advertising giant. We'll speak to the CEO there. That is it for the European market open. Surveillance early edition is up next. Broadly across the benchmark here in Europe, gains of 0.2%. NASDAQ futures rallying up 0.9. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we have two special guests on today's show. Later this hour, we'll be speaking to the NATO Secretary General, Jens Stoltenberg, as we approach 1 year since Russia's invasion of Ukraine. We'll also discuss U.S.-China tensions and Russia's suspension of a nuclear arms treaty. That interview at 9:30 a.m. London time. But first, our next guest runs one of the largest investment management firms in the world. Brookfield has more than $800 billion in assets under management. Based in Toronto, the firm has become a major global player in alternative asset management investments, especially since spinning off 25% of Brookfield Asset Management last December. So for a lengthy and robust conversation, I am delighted to be joined by the Brookfield Asset Management Chief Executive Officer. He's Bruce Flatt. Bruce, so good to finally speak to you in person and here in London. Talk to me about how fundraising can go. When you look at markets, when you look at some of the pitfalls in the economy, inflation, how's it feeling out there?
You know, I would say we raised $100 billion last year. We'll probably raise $100 billion this year. And the difference is many of our things today, many of the things we do, are backbone global infrastructure, and these are what people want to own. They're benefiting or they're positively disposed to inflation in infrastructure, in renewables, in private credit, and these are products that people want to own. So there's money still flowing in significant ways. There are some areas of the business which money isn't flowing in as robustly. Good news is we're not in most of those, and technology would be the biggest one that people are having effects with.
So of course, if you have to get one thing right in terms of capital allocation, that's inflation, and which is why infrastructure is a great place to be right now. Where do you see capital being deployed specifically in infrastructure? There's always a timeline problem, right, of how long these projects take.
Look, these are incredible assets, and the interesting thing is 20 years ago when we talked to clients about putting infrastructure into portfolios, it was they looked at it and said they didn't really understand what it is. After 20 years of showing resiliency, growth, and now through this period, COVID, where they weren't really affected, and now being the positive effects with inflation, people are allocating a lot of capital to them, but it goes all across the spectrum, from pipelines to telecom towers to toll roads to all forms of infrastructure that we invest in around the world, and it has really become a great investment class.
Is there a part of the world where actually this will really come up even more, where it's a better investment to be present now in infrastructure?
Look, I would say that the biggest portion of the world today is in the United States. It's the largest economy. That's where you find the most opportunities always. But the emerging markets, where you pick them selectively, are also great places to invest. For example, we have a large telecom tower business in India where we own 160,000 towers, which span the whole country, and it's an incredible investment. And so the build-out of the backbone of the global economy continues in all these markets, but one must be careful with these type of investments.
Bruce, when you look at infrastructure in the U.S., and we talk about inflation day in, day out, about whether we can avoid a recession where the Fed actually crushes the economy to get to 2%, are you fairly confident that everything you're invested in the U.S. is, if not recession-proof, certainly something that you can manage?
Yes, the answer is yes. We will manage them all. We've been doing this a long time, and we've come through cycles before. And this one is, I think, going to be relatively muted on the recessionary side. But one has to be careful, and you've never got nothing's ever perfect. In investing, you make small mistakes along the way. You learn that way. And but I'd say the U.S. economy is coming through this well. The good news is, interest rates have gone up dramatically,
right?
And we've seen the worst of it. Like, the worst has come now. It all hasn't transmitted through the economy yet, and that's happening. But the worst of the medicine has been dealt out, and I think we're just seeing the effects coming through now.
So I'm surprised, actually, given the leverage that we're seeing, that there are not more companies either going bust or some kind of second round effect.
Look, we had the financial crisis. The banks, through the financial crisis, and the housing issues in the United States were dealt with in a very positive way by the regulators and by the system. And as a result of that, we entered into this period as a system in pretty good shape. And I think we all learned a lot through that period, those periods. And therefore, we haven't seen many big issues.
Bruce, so I think it's very clear where you want to be invested in terms of themes, right? We talked about infrastructure. You also focus on deglobalization. You focus on energy securities and others. Out of these themes, how do you play them?
Look, our playbook is pretty simple. We buy great assets in great places and invest for the long term. And those big themes of decarbonization in the world, deglobalization, just moving things back, and digitalization. Everyone's phone is receiving enormous amounts of information today, and not many people stop to think, how did I get that information? Somebody had to build the backbone, and it used to be we were building gas connections to houses, and we still do. And we were building electricity connections to office buildings. Today, we're building the backbone, the towers, the data warehouses, the fiber to the home, and all this backbone behind what comes onto your phone or your computer.
And so you see opportunities there because maybe other parts of the market focus on the new technology, on the AI, and so that looks expensive, whereas the backbone, the pipeline, as it were, is something that you still see value in.
Yeah, it's just different. We're just different. We own the backbone of the economy. We're not early stage venture investors. We are in a small way, but we're not that type of investor. We put enormous amounts of money into backbone of the economy. And these are 10, 20, 30 billion dollars investments, and they're very large, and that's significant. Now, AI is benefiting all of these. When you think about it, the amount of storage capacity, therefore, to come to your phone, the amount of storage capacity is enormous. So the use and the capacity that we have to build for data warehouses, for the fiber to the home, for the telecom towers, the amount of data that's stored on it is dramatically different than what it was before. So all of these things are just increasing exponentially the capacity required, which means that more money needs to go into infrastructure.
So talk to me also about deglobalization. Now, I was particularly interested in this theme because this touches everything, right? It touches how we play with China. It touches on some of the emerging markets. Like, how much more onshoring do you see in the world economy?
Look, there's two things going on. International companies are moving some of their supply chain to other countries. I'd say India is one where there's no doubt international companies are serious now about putting more manufacturing capacity there. But on sophisticated supply chains for healthcare, pharmaceuticals, and semiconductors, and products like that, there's an enormous amount of money being invested and going to be invested. We just we announced last year a transaction with Intel where we're building with them, or we own half their plant in Arizona, and this is a $30+ billion plant. So it's a very significant reshoring of semiconductor chips.
Is India still a good opportunity? I know you were one of the earliest, I think, investors, or the most prominent investors. You don't have exposure to Adani, but does it change the psyche of investing in India?
You know, I'd say we were always careful when we went to India. We spent a lot of time building out our own people and our own business, and we're in the market, and that's given us a great advantage to invest on our own. And so we've done extremely well over the years. We have a great franchise there. We're still putting money into the market. And I'd say when capital is less freely available, it's better for us in the type of investing that we do, because the entry point where you invest is often really important. And less capital available means less people are chasing it, therefore opportunities are better.
And so you see that? Do you see opportunities in the next 12 months?
Yes. Yes. Look, the next 12 months are going to be an excellent investing environment. A lot of people are negative. That means it's a great environment to invest. So we're going to continue to be putting money to work in this environment.
How much money? It's riskier also.
You know, it's less risky. This is why it always seems like it's more risky. It's actually less risky. You know, just to make the point, equities are down. Equity markets are down, which means that if you invest $1, it's over the longer term, it's less risky. Fixed income is down, meaning interest rates are higher, therefore the probability of losing money is a lot less. Bitcoin is down. Not that I'm investing in Bitcoin, but growth stocks are down. Okay. So everything has come down in the markets, and that is that means that the returns going forward will be better. Therefore, the risk is less. Now, it doesn't feel that way.
It feels choppy, doesn't it? It feels a little bit volatile.
It just and that's why it's a good market to invest in.
All right, Bruce, don't go anywhere, because we'll be back for our exclusive conversation with Brookfield Asset Management Chief Executive Bruce Flatt. I'll also ask him if he's investing more or less money in China. That's coming up shortly, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacroix here in London. Now we're back with Brookfield Asset Management Chief Executive Officer Bruce Flatt. Bruce, thank you so much, first of all, for sticking around. Now you're explaining to me that given some of retrenchment in markets, actually it's good opportunities for you and Brookfield. What does it mean for companies that you will either want to IPO or put out there? I know there are questions about what you do with some of the UK assets, including Central Parks.
Yeah, look, our investments around the world. We last year, for perspective, we raised $100 billion.
Yep.
We invested $55 billion. We sold $35 billion of assets. This is a vast business. So we're always buying things. We're sometimes selling things. And the UK, we have a $60 billion business. We have a lot of infrastructure, renewables, real estate, and from time to time we look at taking. An IPO is really just a possible sale of an asset. En bloc, it could go to somebody else or it could go into the markets. I wouldn't say the markets for an IPO are attractive today, just given valuations in the market.
So you would wait for a more attractive market, or would it, strategically?
Maybe you'll sell it to somebody else. You'd sell it in the private markets. Remember, price and value are two different things. Value is what the asset's worth, and price is what it trades at in the market. Today, it's better to be buying in the public markets than it is to be selling, because price is often today, just given the volatility we just talked about it, price is often lower than value. Therefore, it's probably better to sell it in the private markets if you're going to sell it, or you just wait.
Yeah. So are you looking to sell Central Parks?
We've owned it quite a long time. It's in a fund which has a life on it. It still has a long time to go. So sometime in the next 5 or 7 years, we'll sell it at an opportune time. It's doing really, really well as a business. As many people know, everyone in the UK knows what Central Parks is. It's a phenomenal place to go and have a holiday, and it's been an amazing business even through COVID, and now it's doing really well.
How do you look at China? So are you deploying capital in China? Again, it's been quite a roller coaster, actually, for the economy for the last 2 years.
Yeah, look, our business, we invest for clients, and some clients don't want to be investing in China, and some have a very strong interest in investing in China, and therefore we're still investing for those clients in China and not for the others. And it just depends on what it is. We have a big team in Shanghai, and we continue to invest for the clients in China and in Asia and others that want to be investing in China. So our business is very different than if you own an industrial business and you're trading over a border and you have to make decisions. So we take our balance sheet and invest. This is a different decision for us.
Bruce, talk to me about real estate. So there were defaults on 2 loans. I don't know what that means for, how you see real estate in various parts of the world and the level of distress you're seeing in those.
Yeah, I would say that there's a real tale of 2 cities. Firstly, anything that's gone on with us, it's just regular business. This is small and not relevant to the overall business. We have a vast business, and everything's financed non-recourse. Therefore, it's not really relevant to the overall business. More importantly, what's going on in the world is there's this, and it always happens, the best of the best and the worst of the worst. The best of the best today is really, really good. For example, in New York, our office buildings we're leasing, Manhattan West, for example, it's a big office complex on the west side of Manhattan. Rents are 50% higher than they were pre-COVID. We're 97% leased. We just leased one full building up of 2.25 million square feet. We did 3 million square feet of leasing last year. So the high quality space is very sought after by companies because they want to bring their people back and have new engaging space. And so that's what's going on.
So is that Canary Wharf? I mean, do you have anything similar in the UK, or is it a little bit more touch and go?
Look, we just up the street from where we are here, we just built 100 Bishopsgate. Yeah. It's 100% leased. Rents are way higher than we thought we'd rent at. We're leasing up Leadenhall up the street from that. Rents are very high. So great space is achieving great rents. In Dubai, we just leased up a building. It's the best building in Dubai at rents, I'd say double what we thought we would rent them for.
So iconic in great places go really well. What's,
on the, look, what's always been that way is if you have poor real estate in poor places, and today poor, before it used to be location. Right. Today it's quality of air systems, quality of everything in the building, layouts, old building, and those buildings are in trouble.
So will you see more like defaults on loans? And I guess this is COVID related.
Part of it is. Part of it's just a continuation of things going on before COVID just increased it. But I don't think, I'd say real estate in general, the news out there is much, much worse than the underlying fundamentals. In fact, fundamentals today are probably better, almost better than they've ever been going into a recession. Remember, when the financial crisis happened, we emptied buildings out in Canary Wharf. Like Lehman Brothers went bankrupt, one day, a whole 1 million square foot gone. Today, we're 100% leased.
So why do you see that difference between, I guess, perception and reality in your eyes? Is it inflation? Is it interest rates going higher? Don't blame the media.
You asked me, I'm going to say it's the media.
No, of course it's not the media. We report the facts.
Look, I think there's real estate has many changes that go on. It's the largest business in the world. Remember, it's the largest business in the world. Everyone has a piece of real estate or lives in one or is near it or they go in it every day. And therefore, everyone has an opinion. And it's a constantly evolving thing. It's like retail's been constantly evolving. And the trends, the negative or positive things get exaggerated.
Yeah.
And I think it just gets exaggerated until it settles down.
Bruce, in terms of share buybacks, I know you've been frustrated, right, with the share price level. Are you going to continue buying back shares when it's not good enough?
Yes. The answer is all company people responsible for companies should look at capital allocation. One of the great things to do is to buy what you own. And we continue to buy back shares in all of our companies when they're not properly valued in the marketplace. And
how do you define that? Is it like a target?
Look, we know the assets all the time. And again, I'll go back to price and value. We know what the value is of our business when the price isn't achieving, when the price in the market is higher or lower, we know we should either sell here or buy there. And now, we're running a business, so we can't use all our capital to do that. But on the margin, over the longer term, it's always really good for shareholders to buy back stock in the company and sink the shares in essence, you're buying back what you already own at a discount to the value, and that's highly positive to the owners that are left afterwards.
Bruce, thank you so much for a great conversation. The first one of many, I hope, so you'll have to come back in the studio. That was the Brookfield Asset Management and Brookfield Chief Executive Officer, Bruce Flatt. Now, coming up, NATO Secretary General Jens Stoltenberg on the Ukraine war, U.S.-China tensions, and, of course, the future of the alliance. That interview is coming up shortly. Don't miss that conversation as well. This is Bloomberg.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody is talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Federal Reserve officials anticipate more rate hikes to curb inflation, though most support slowing down the pace. Minutes from the Fed's meeting 3 weeks ago say almost all officials agreed to an increase of 25 basis points. Only a few were said to have supported a 50-point hike. Now, President Putin says he is waiting for his Chinese counterpart to visit Moscow. Xi Jinping is reportedly preparing for a trip in April or May to push for multi-party peace talks. China's top diplomat Wang Yi met with Putin in Moscow, calling the relationship between the two countries solid as a mountain. G20 host India is said to be seeking to avoid using the word war in any joint statement which refers to Russia's invasion of Ukraine. That would diverge from a consensus reached by leaders in Bali last November. A source says Indian officials would prefer using words like crisis. We're told the hosts are also concerned that plans for additional sanctions on Russia will draw attention from other G20 priorities. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you. Coming up, NATO Secretary General Jens Stoltenberg on the Ukraine war, U.S.-China tensions, and the future of the alliance. That interview is next, and this is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about, mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, you know, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Farrell. Weekdays on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, coming up on today's program, the NATO Secretary General, Jens Stoltenberg, joins us live from Brussels as we approach 1 year since the Russian invasion of Ukraine. Also on the program, could a post-Brexit trade deal on Northern Ireland unleash tens of billions of pounds in business investments for the UK? And the veteran investor and campaigner Helena Morrissey tells us about her 3-year plan to double the number of female fund managers in Britain. So tomorrow marks 1 year since Russia launched its war on Ukraine. The invasion has upended security in Europe, placed pressure on NATO, and not seen since the end of the Cold War. So to discuss this and much more, I'm very pleased to be joined by the NATO Secretary General, Jens Stoltenberg. Mr. Stoltenberg, thank you so much for giving a bit of your precious time to Bloomberg. It's a year since Russia's invasion of Ukraine. There's no sign of a peace deal. How does Russia think they will win this war?
So what we see now is that President Putin is in no way preparing for peace. He is preparing for more war, launching new offensive operations. So we need to support Ukraine to ensure that they prevail as a sovereign, independent nation. And this has now become a grinding war of attrition, which is actually a battle of logistics, meaning we need to ensure that they get the ammunition, the fuel, the spare parts, and all the weapons they need, the Ukrainians, to liberate their lands, and that's exactly what the NATO allies and partners are doing.
Secretary General Putin also said in a speech that Russia will, of course, suspend New START, which meaning that there are no treaties governing the nuclear actions of Russia, of the U.S., let alone China. What does that mean for NATO? Does NATO need to do anything to prepare for this?
So I regret the decision by Russia to suspend their participation in the New START agreement. This is one of the very last agreements of arms control, and the New START agreement is an agreement that limits the number of long-range missiles, strategic missiles and weapons. And of course, this is a reckless decision because we need arms control. And we need transparency. So we call on Russia to reconsider and to respect and to fully implement the New START agreement, including the inspection regime, which is extremely important. And then, of course, we will closely monitor what they actually do. Russia has, over the last years, invested heavily in new modern nuclear capabilities, and we are taking the necessary steps to ensure that our deterrence remains safe and credible.
But does an unregulated nuclear world mean Vladimir Putin is more likely to use nukes?
First of all, a world without nuclear arms control arrangements, agreements, risks leading to more nuclear weapons. And we need to understand that this is part of a pattern. Not so many years ago, Russia walked away from the INF Treaty, and the INF Treaty banned all intermediate range weapons. And now they are starting to walk away from the New START agreement, banning or regulating the number of long-range weapons. So more nuclear weapons, of course, makes the world more dangerous. And that's exactly why we need the agreements. That's why we need the transparency, the inspection they facilitate. And that's also why the Russian decisions to violate the INF Treaty, to suspend the New START Treaty, these are reckless and dangerous decisions.
Secretary General, China looks set to become more engaged in the Ukraine crisis, either through a peace plan or, according to us, even through providing arms to Russia. What would the arrival of Chinese weapons on the battlefield mean for NATO?
That will be a big and serious mistake by China if they start to provide lethal aid to Russia. So far, we haven't seen that happening. But we have seen signs that China is considering to provide military aid to Russia. And we are watching closely. And of course, China should not do that, because then China will support an illegal war or aggression against a sovereign independent state in Europe, Ukraine. And China, and this will be a blatant violation of the UN Charter, and China is a member of the UN Security Council, so they should not violate the UN Charter, and that's a clear message from NATO allies and from the United States and others.
But are you concerned that this for NATO could quickly lead to a proxy war between NATO allies and a Cold War type scenario with Iran, Russia, China, and North Korea?
First of all, we need to understand what this is. This is a war aggression by Russia against Ukraine, and Ukraine has the right to protect and defend itself. That is a right which is enshrined in the UN Charter, and we, NATO allies, we have the right to support Ukraine. NATO allies are not party to the conflict, but we support Ukraine in upholding the right to defend their own country. Russia is violating international law. Russia is launching this war against Ukraine, and Russia is reaching out to other authoritarian regimes like Iran, and we have seen the Iranian drones, but also North Korea, to get ammunition, to get weapons, to get support. And again, our only answer to that is to ensure that we provide sufficient support to Ukraine so they can prevail and push back the Russian invaders. And China should not, of course, become part of this by providing lethal aid, military support to Russia. The challenge and the problem is that China has not yet been able to condemn the invasion. And we see how China and Russia are working more and more closely. And of course, this is something which we follow also very closely from the NATO side.
Mr. Stoltenberg, what likelihood do you attach to both Finland and Sweden being members of NATO by that mid-July Vilnius summit?
I'm confident that both Finland and Sweden will become NATO allies. All NATO allies, also Turkey, made an historic decision last July at our summit in Madrid to invite Finland and Sweden, and all allies also have signed the accession protocols. And so far, 28 out of 30 allies have already ratified. Hungary has made it clear they will ratify the two protocols for Finland and Sweden early March. I welcome that. I met with President Erdogan last week. I see some encouraging signs. I think it's absolutely possible to get Finland ratified in the near future, and we continue to work for that. And then on Sweden, there are some more challenges that has to be addressed, but President Erdogan and I agreed last week that there will be a meeting between Finland, Sweden, and Turkey in Brussels mid-March here at the NATO headquarters, and under my auspices, and they will sit down and meet and try to address the challenges we have to overcome to ensure that also Sweden becomes a full member in the near future. My message has been all the way that both Finland and Sweden should be ratified now. They are ready and they should be ratified, but Turkey has another position, and therefore we need to find a way to solve that issue.
Mr. Stoltenberg, thank you so much for your precious time. Jens Stoltenberg there, the NATO Secretary General, joining us live from Brussels for an important conversation. Now, for more on the war in Ukraine, William Albuquerque, Director of Strategy, Technology and Arms Control at the International Institute for Strategic Studies, also joins us now. William, thank you for joining us. What happens in the next 12 months? How does this war end?
Well, it's a great question. I think what we're going to see, at least in the short term, is the Russians are going to continue this grinding war of attrition, trying to bleed the Ukrainian forces as much as possible. They think they have significant advantages in manpower and in battle tanks, even though they're very old battle tanks, that they're going to use along with artillery to grind the Ukrainian forces down. The breakthrough could come with the modern Western battle tanks, especially the Leopard 2 battle tanks that have been pledged by so many countries across Europe. These can provide Ukraine with the ability to break through the Russian lines in unpredictable places, to form a real armored core that can spring some strategic surprises on the Russians and throw them back. So we could see in the early spring, mid-spring, into the summer, some Ukrainian counteroffensives that take the Russians by surprise, that throw them backward, and start to bring Russia back to the position they were at the beginning of the war. The big question is always going to be Crimea. How can they advance on that front? And I think once Russian forces are being pushed back in the east, then Putin starts to think about how to negotiate his way out of this war.
Well, we had a good conversation there with the NATO Secretary General, trying to understand also, the China fault line. So whether they're the peace provider, whether they're actually arm Russia. Where do you think this will go?
I don't think China wants to get dragged into this conflict. I don't think they want to provide Russia with military equipment. I think that's why you hear the noises out of the United States that they're considering exposing some classified information about conversations that are happening in China. Note that the U.S. isn't saying that they're going to expose actual weapons transfers. So the U.S. is trying to do what they've done throughout this conflict, which is the selective use of classified information in order to prevent bad things from happening, whether it's Russian false flag attacks or now the provision of Chinese military equipment. Because if China does provide military equipment, that gives Russia an enormous well of support to draw upon for more missiles, more ammunition, more artillery. It would be very deleterious to the Ukrainian chances for victory.
So where do you see the UK on this? I know there's been a call for the Prime Minister to send some of the fighter jets to Ukraine. They have promised some longer range weapons. How crucial is the UK's role in this?
Right. Rishi Sunak promised Storm Shadow, which is a longer-range missile that can really help Ukraine start to destroy some of the Russian logistics, command and control, and centers from which they're launching their own missiles and aircraft. So I think that would be a real game changer. I think that would really help because if the UK starts selling the longer-range systems, that may break some of the logjam in the United States, where the longer-range ATACMS artillery for the HIMARS has been something that the Ukrainians have been begging for throughout the conflict. So that could really make a difference.
All right, thank you so much for joining us. William Albuquerque there with his vast experience, of course, on the ground, Director of Strategy, Technology and Arms Control at the IISS. Coming up, Karen Ward from JP Morgan sees the UK benefiting from an investment boost if a post-Brexit deal is realized. We have the latest on the Brexit talks next, and this is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacroix here in London. Now, we're still waiting news for a potential deal between the UK and the EU on changes to post-Brexit trade arrangements for Northern Ireland. But some economists are already looking at the potential upside for investment in Britain when an agreement is reached. Now, we're now joined by Bloomberg's UK correspondent, Lizzie Burton. Lizzie, great to have you on the program. So what kind of boost can we expect?
Well, some economists, Francine, that I've spoken to say that if there were a Northern Ireland Protocol deal, it would reduce uncertainty, which would boost investment and then boost growth. So Callum Pickering, who I know you often have on the programme from Berenberg, said in a note to clients that actually the uncertainty around a potential trade war with Brussels is hanging over investors, and they've built up a £100 billion war chest of cash since the pandemic. Unlocking a deal might help to get some of that investment into the economy. I also spoke to one of the Chancellor's economic advisors, Karen Ward at JP Morgan Asset Management yesterday. Take a listen to what she had to say.
The numbers are that UK business investment is about the same level that it was in 2016. The likes of France and Spain, those numbers are around 20% higher. So it would be really meaningful. And of course, with investment then solves all the other economic ills that we have, which is low productivity, low real wages, fiscal drag. So it really is the secret sauce for economists, business investment.
So I was quite surprised that Karen Ward would say this to us on Bloomberg Radio yesterday, but it means that the Chancellor clearly is aware of the economic benefits of a deal. What I would say, though, is that Brexit's impacting the economy not just through business investment, but of course also through the labour market and trade. And business investment isn't just being hampered by Brexit, it's also the tax environment. But if the government could get more growth, potentially it could deliver those tax cuts that so many in the Tory party are after.
Now, speaking of the Tory party, what is Labour doing? So we're expecting a big speech in Manchester from Keir Starmer.
Yes, it's in the next hour. We're going to see Keir Starmer on his feet at 10:30. At that moment, we're also expecting a document setting out what Labour would do if it were in government. Not quite a manifesto, but the first pledge of 5 is expected to be that he'll grow the economy to be the fastest growing in the G7. Now, on that pledge, you have to ask, how impressive is it? Because is it more about the pace or is it about the level? And how is he going to do it without boosting immigration, on which he's been really tough in his talk lately? The other goals we reckon will be on the NHS, crime, education, clean energy, and you might be having deja vu because, of course, the Prime Minister set out his 5-point plan for growth earlier, and his priorities earlier in the year, and they both hark back to Tony Blair back in '97.
There you go, 5 points. It's less than 6. It's more than 3. It's like a beautiful number. It kind of sets out the agenda. It is neat and it's substantive. Talk to me about the Northern Ireland Protocol. Are we going to get a deal?
Well, we're currently expecting, hopefully, maybe they can get a fudge by next week. We heard the Prime Minister at Prime Minister's Questions yesterday sparring with Keir Starmer. Rishi Sunak suggested that a legal change would be needed to the Northern Ireland Protocol to address this democratic deficit. But we hear constantly from Maroš Šefčovič, the European Commission Vice President, that it's unrealistic to expect a renegotiation of the protocol. At this point, what people in the Tory party, the Brexiters, want is to see the deal. They're frustrated by this strategy of trying to get them to agree before they see it. But the risk, of course, for Rishi Sunak is if he lays his cards on the table too early, there's a big political humiliation that he has to rely on the votes of Labour to get it through Parliament. But Keir Starmer clearly trying to coax Rishi Sunak into that checkmate position at PMQs yesterday.
Yep, a lot going on. Thank you so much, Lizzie Burden. And of course, we wait for that Keir Starmer speech in about an hour. Now, coming up, there are fewer than 200 women fund managers in the UK. Veteran investor Helena Morrissey is working on changing that. We'll bring you more of that conversation next. And this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Moment news breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance. Actually, Bloomberg UK. I'm Francine Lacqua here in London. Now, despite a push for gender parity in recent years, fund managers in the UK are still overwhelmingly male. There are currently only around 200 female money managers here in the UK. Well, that works out at just 1 in 10 of the people who run Britain's portfolios. Veteran investor Helena Morrissey is looking to change that. Well, Bloomberg radio anchor Caroline Hepker spoke with the British financier on her new high-intensity mentoring program, and she's here with me. Caroline, it was a great interview. So what exactly is Helena Morrissey trying to do?
Yeah, so Helena Morrissey is the chair of the Diversity Project, and they've got this new pathway program. So we know that the gender diversity numbers in the UK in money management have basically stalled. Last year, according to Citywire, only 12% of people managing money were actually women. That has stayed the same for quite some years. So I spoke to Helena Morrissey around this. The Pathway program is training up 60 women in the UK this year. Very intensive program. And she's clear about what the goal of that is. It's to get those women into money management, but to manage a fund and to be the named person on that fund, not just within the team. So it's a really ambitious program, and she wants things to change. So have a listen to what she had to say. I asked her basically why she thinks the numbers have stayed so stubbornly low.
I learned from the 30% Club experience, that was an initiative to create, better gender balance on boards, at least 30% women. We only made headway when we involved men in that. And so we do need to be, I love your expression, Caroline, muscular, because it should feel very robust. It should be like you've got a business objective here. Let's improve diversity of talent.
So Helena Morrissey there speaking. So she was talking about the 30% Club, which was one of her previous initiatives. She's had a long career. She has managed money. She sits in the House of Lords. She's the chair of the Diversity Project. The 30% Club was to try to get women on boards to increase those numbers for listed businesses up to 30%. So she's using that experience to bring to the Pathway programme. And as I sort of said to her, this is more muscular. We've had so many initiatives, so much talk about change, but this is very practical. It's about getting these women into the top jobs. And these 60 individuals come from 33 different companies. They are global businesses. So one of the mentors was saying to me, which I thought was very interesting, this isn't just something for the UK. These 33 investment companies are global businesses.
I mean, I don't know how much it moves the dial. Certainly, what was behind her inspiration? So from 200, does she have a target of how much she wants that to be?
She was quite reluctant to talk about that. She said that a lot of people are asking her, is this going to be a permanent program? Is this going to be a global program? She was reluctant to sort of make any commitments. She was saying she's focused on making this year's intake a success. And speaking to the women, which I did for radio, I did a whole kind of bespoke piece, which was really fun.
Love it.
Back to my reporting days, which I loved. Speaking to the women who were taking part, the mentees and the mentors, they were quite realistic, a bit sort of pessimistic sometimes about the issue, but also hopeful about this programme. Have a listen again to what Helena had to say.
I honestly don't want us to need to have this type of program in a decade, and I actually think that's within reach. I saw with the 30% Club that when change starts to happen, it can really accelerate and you get a new sense of what's normal. And you're right, I smiled when you said legacy, because it sounds like, they used to call me a veteran. Now with legacy, I'm like beyond the grave next. I mean, I hope this is not sort of, my parting shot, but I've always said, I really don't want to leave this industry until it looks and feels very different. And for me, that means that we have, as many women in it as men, and say people expect, if they have a fund manager come and visit them, and if they're a client, they have just as much expectation it's going to be a woman as a man.
Well, thank you so much for that great interview. Of course, great reporting for our Bloomberg radio anchor, Caroline Hepker. Now, also subscribe to Bloomberg's In the City podcast that I host alongside David Merritt on Apple Podcasts, Spotify, or wherever you get your podcast. It's out today, is on a similar theme. Luke Ellis of Man Group on social mobility in the UK. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around US politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We should be in a recession right now, and it's just not happening.
The Fed doesn't even know. We don't know what to look for.
You're looking at an environment where the Fed does need to be tighter.
We've pretty much annihilated the probability of rate cuts towards the end of 2023, and now we're seeing, 3 rate hikes over the course of the next few months.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The Federal Reserve is inclined toward more interest rate hikes to fight inflation. Still, minutes from the last meeting show almost all Fed officials want the pace of increases to slow down. G20 finance ministers meet in India with the war in Ukraine overshadowing their agenda. We'll talk to someone who's there, Spain's Deputy Prime Minister, Nadia Calvino. And a push into artificial intelligence processors is helping NVIDIA. Shares are higher after the company comes out with a bullish outlook. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, yes, there's the macro story, there's the post-Fed minutes reaction, but then there's NVIDIA, which really does seem to have reignited the animal spirits.
Absolutely, really pushing us back to risk on. And we've heard so many people in the last few weeks say it's less about the macro picture now and more about earnings. That hasn't proven true in terms of market pricing on the indexes. We saw a big drop day before yesterday, the biggest all year, and a huge jump in rates, all due to Fed speak and continued inflation data. PPI was really what set that off. But now maybe earnings are really going to come into focus. Take a look at S&P futures, up about 0.4%. The index, the cash trade, really didn't drop too much yesterday, and we did have a rise in the NASDAQ again. The NASDAQ is up still more than 10% year to date, while the S&P is only up about 4% year to date. The U.S. 10-year yield had come off a little bit. Now it's up another 2 basis points, but still 393.71 is a little bit lower than where we saw it at this time yesterday. And NYMEX crude is also coming back a little bit, but itself a little lower than we saw it at this time yesterday. 74.17 for a barrel of West Texas Intermediate. Finally, Bitcoin at 24,299 is just about exactly where it was 24 hours ago. But what astonishes me is the lack of volatility in this digital asset. We really didn't see it come down with the latest move in equities or in yields. It just has managed to stay at the same level. Take a look at what's going on in Asia. We are going to talk to the CEO of the Hong Kong Stock Exchange a little bit later on in the program. The MSCI Asia Pacific ex-Japan index rising 0.25% ex-Japan because Japan is closed for a holiday today, so you won't see a quote on the Nikkei that's any different than yesterday. The Hang Seng in Hong Kong down 1/3 of 1% at 20,351. We're looking at some more weakness in the U.S. dollar versus the Korean won. This is interesting after a pause for the central bank there, because we had seen the dollar really strengthening again against the won, and now it's coming off a little bit. So if you watch this pair, that's a turnaround, and the dollar strengthening against the yen right now at 134.85. Anna, what do you see in terms of Europe?
Well, here in Europe, then, we see a pretty mixed picture across European equity markets. Geographically speaking, at least, Matt, we've got weakness coming through in the London market, basic resources and the mining sector, partly responsible there. The auto sector and technology doing well, and that plays well for the German market. So we see the German and the French markets on the rise. A quick data point for you. We just got Euro area core inflation, and this is the core number, accelerating to a record of 5.3% against an estimate of 5.2. So not much over the estimate. And this is core. This is not the headline figure, which has come off those recent highs as we've seen in other geographies, but it's the core number that is still advancing, is still going higher, and that no doubt a bit of a headache for those at the ECB. Here's the move in technology shares that we're seeing up by 1.2%. Maybe it's that NVIDIA story helping to lift sentiment surrounding that sector. Anglo-American is partly responsible for the weakness in basic resources, but it's been a theme of this week. Earlier this week, we heard from Rio Tinto, we heard from BHP, both of those businesses seemingly disappointing the markets with the amount of money they're returning to shareholders, and to some degree the numbers. Anglo-American, some similar stories, but with some differences. A big impairment charge they're having to take on part of their fertilizer business in the UK. Rolls-Royce, a completely different story, and this is an incredible move for a business like Rolls-Royce, the engine-making business, of course, not cars, up by 18.9% here in the UK today. Wow. And they beat estimates. They're talking about the strength in their operations under a relatively new CEO. They're talking about transformation and the strategy, and also possibly about return of cash to shareholders. And so all of that adding to some upside on that particular share price. And this is the UK 30-year yield. I just put that in here as we're keeping track of where we are on the yield story, as we're seeing various curves adjusting to this higher for longer mantra that the market seems to be coming round to. We're kind of back to where we started the year on the UK 30-year yield. And actually, the UK a bit of an outlier today in Europe, seeing those yields go just a touch higher.
Amazing to see that Rolls-Royce move. I mean, a $10 billion business gaining a fifth overnight on possible strategic changes is a huge story. Let's get, though, back to the macro picture. The minutes from the latest Fed meeting show the central bank is inclined toward more interest rate hikes to curb inflation, if you hadn't already woken up to that. Meanwhile, New York Fed President John Williams says it's critical the central bank stay committed to its 2% inflation goal.
Price stability is, in fact, the foundation of economic prosperity. Without price stability, all of the other goals that we have, whether maximum employment or low and stable or low interest rates, can't be accomplished. So that's an absolute imperative for us.
Bloomberg's Valerie Teitel joins us now for the key takeaways from the Fed minutes. And Valerie, I thought, one of the most interesting things was the minutes seem more hawkish than Powell did at the presser. There was no talk, for example, of a pause, and he wasn't very firm about that.
Yeah, also, Matt, there was no mention of the word disinflation, which he seemed to say ad nauseum in that Q&A. But let me go back to a few things. The first one for me was that only a few wanted a 50 basis point hike. That implies that Bullard and Messer maybe only had one friend in that 50 basis point camp. The market took a sigh of relief on that one. But on the hawkish side, there was no mention of a pause. And as I said, there was no mention of this word disinflation. Instead, there was a big emphasis on maintaining the restrictive stance. And then lastly, for me, they only focused on the upside risk to inflation, saying that that's key to their policy. We had some soft CPI prints heading into this January Fed meeting. Some suppose there would be some focus on the downside risk to inflation, but there wasn't. This all goes to say that there has been a 50 basis point shift higher in the Fed's terminal rate, somewhat implying that the March dots do have room to move higher when the Fed convenes again on March 22nd.
Yeah, that's interesting, because it asks questions about the extent to which the market has already front-run the hawkishness we saw there, or whether there's more to come. On to other matters to do with the Fed then, Valerie. Vice Chair Lael Brainard departs the Fed this week. This has crept up on me more quickly than expected. Any hints on who's going to replace her in this key seat?
Anna, there was a report out from the Wall Street Journal that named two names, both economists who have previously worked in the Obama administration. I want to talk about Janice Eberly here real quick. In 2019, she co-authored a piece that found that a 3% inflation target would have been better in the aftermath of the global financial crisis to aid recovery. It's very clear from these initial rumored picks from Biden that he is looking for a dove to replace Lael Brainerd in that vice chair seat.
Okay, Valerie, thanks very much. Certainly want to watch Bloomberg's Valerie Teitel with news on the markets and key appointments. Let's get over to the tech space. NVIDIA is edging higher in US pre-market trading after it gave a bullish revenue outlook for the current quarter. The push into artificial intelligence processors is helping offset sluggish demand for PC chips. Joining us now on this and other tech news, Bloomberg's Tom McKenzie with the details. Tom, good morning to you. So what can you tell us about these results?
So it's the guidance, particularly the first quarter leading up to April. They're expecting sales of about $6.5 billion US, well above the estimates. And as you say, that is impingent, or at least contingent, on what they see as demand for AI chips. And as you say as well, of course, a key revenue driver for NVIDIA has been the gaming part of the business, gaming chips. But what they've successfully managed to do, it seems, is pivot from gaming to AI, using those chips that are well-versed in terms of crunching the data for AI applications, and that's where they're seeing the demand. They also announced that they're setting up an AI cloud service in partnership with the likes of Microsoft, Oracle, and Google, so that could be another revenue driver going forward. Just for the context, NVIDIA is one of the best performing, in fact, the best performing chip company within the Philly index. It's going to more than 40% year to date. And again, investors rewarding this company on this upbeat guidance.
All right, AI certainly hot this earnings season.
Yeah.
In terms of a much longer term bet, Apple apparently making headway on its glucose tracking watch, which, Tom, I think is fascinating as the growth of diabetes is monstrous globally, and this would allow them to test your blood sugar levels without, a pinprick.
Yeah, and as you say, look, this is an enormous potential market. So 1 in 10 Americans alone suffering from diabetes. So what are we talking about 40 million people. Yes, you're also right to say this has been a long-running project, more than 12 years, highly secretive as well. And what they're trying to do is use the hardware that Apple has at its disposal with the software to do this non-invasive, and as you rightly point out, that's key to this, non-invasive blood glucose testing. So they use photosonic, things called silicon photonics, which is a part of chip technology, silicon photonics with lasers and with their own algorithms to measure glucose levels. They say they're at proof of concept level. They're still a number of years away from getting it onto the market. They need to shrink it. That's going to be key for them. They're at the point now where they're trying to get this product down to about the size of an iPhone to put onto your bicep to measure these glucose levels. But as you say, we're a number of years away. They said they've had some major successes. It's been cloaked in secrecy, but the market potential is clearly huge for them.
Okay, Tom, thanks very much. Bloomberg's Tom McKenzie with those tech themes for us. Back to the geopolitics. India is hosting the G20 finance chiefs meeting this week. US Treasury Secretary Janet Yellen's comments at the gathering mark a shift in tone on the global economic outlook from the last time the world's top policymakers met in October.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago. In the fall, many were worried about a sharp economic slowdown across the world. The challenges we face are real, and the future is always uncertain. But the outlook has improved since we gathered in the fall.
US Treasury Secretary there talking about the improving outlook. We're joined by Bloomberg's Haslinda Armen, who is going to be speaking to Spain's Deputy Prime Minister at the G20 meeting. Haslinda, good morning.
Well, Anna, the world economy may be in a better place, but there are lots of challenges, including debt restructuring. 60% of developing nations are either in debt distress or close to it, so it is a huge issue. Let's get perspective from Spain's first Deputy Prime Minister. Good to have you with us, ma'am. We talk about debt restructuring. It's a huge issue here, and some say that perhaps China is dragging its feet. I mean, where are we in terms of progress?
Debt restructuring is undoubtedly a very important element, a key tool to provide financial support to most vulnerable countries, as you say. And there are many discussions ongoing in different fora, and I hope that we manage to find a breakthrough, including also private sector participation, of course.
But some say there needs to be some tweaking in the common framework. I mean, what can be done?
At the end of the day, what we need is the will of all the key creditors. They must all contribute so that we manage to provide this debt relief to most vulnerable countries and thus reinforce the whole financial safety net.
The thing is, the US, even India, they want China to take a haircut. But China says for them to take a haircut, it wants the World Bank to do it as well. Should the World Bank take a haircut as well?
We need to have a broad and balanced approach because we cannot endanger the AAA and the role of the World Bank and the IMF as lenders of last support. We cannot weaken the multilateral framework in this discussion. So that's why I was saying we need to all get together and find a balanced and the right approach that provides relief without weakening the common safety net.
We heard from U.S. Treasury Secretary Janet Yellen just slightly earlier. She's also pushing for reform to the World Bank. She says that the World Bank needs to expand its balance sheet, for instance. The World Bank currently is undergoing a leadership change. Who would you like to see there? Should we see yet another American?
Oh, well, I wouldn't get into that discussion. I think the most important issue is not so much the person, but rather what kind of structure and multilateral framework do we think we need going forward? Actually, our frameworks have served us well to respond to the pandemic through good coordination of monetary and fiscal policies and the strong role of the World Bank and the IMF. We have prevented a massive financial crisis, as happened, in 2008. And so we need to continue to reinforce our multilateral framework with the institutions based in Washington and other development banks throughout the world so that we can ensure financial stability and therefore strong, sustainable growth.
Leadership does matter. Countries like Indonesia, India feel that it is time for someone from the developing world to be leading the World Bank. After all, if you take a look at growth, 80% of growth this year will come from developing nations. Shouldn't that be reflected in organizations like the World Bank, like the IMF?
Well, obviously, right now we are in a tectonic shift, of the common world order that has served us since the end of World War II. I think there are many changes and also geopolitical challenges and tensions are taking place, mostly due to the war in Ukraine most recently. I think that we definitely need to see how to put the building blocks of this new world order, and countries such as India have a strong voice and have an important role to play, and that's for sure. And I'm very glad that the G20 is taking place in India because I think that can help us find a way forward in many of the challenges of the present and the future.
Speaking of Ukraine, we're marking the first-year milestone tomorrow. We know that the EU has frozen quite a lot of Russian assets and are considering investing those assets to help the reconstruction in Ukraine. Your thoughts on that and where the process is right now?
Well, yeah, 1 year after the beginning of the pandemic, actually, President Sanchez from Spain, he's visiting Kiev today, and I will this afternoon be signing the Spanish contribution to the new World Bank Fund to support investment into the health infrastructures of Ukraine, saving lives. So this is very important. We continue to support Ukraine. I think that the major development would be if the war would end, because the war is right now the main element of uncertainty and concern at global level with a long-lasting and a broad impact throughout the world. And so the sooner it ends, the better, because then we can resume the path of strong, balanced growth that we were on after the pandemic. Now, we will have to think about the reconstruction, indeed, but I think right now our focus should be on ending the war as soon as possible.
But should those frozen assets be invested for reconstruction efforts? Is it even legal? Where are conversations?
Well, this is an issue that will have to be considered as many other elements when the moment comes. I think that right now the focus should be on ending the war as soon as possible and supporting Ukraine through investments like the one I just mentioned in health infrastructures, in the basic elements for people to live. I mean, this war has already taken too many lives and we should stop it as soon as possible.
Earlier we talked about inflation, how it remains sticky. It is one of the huge issues for central bank governors right now. Inflation, food inflation in particular in Spain remains high. What are the efforts? How will you contain those prices?
Well, luckily, I mean, Spain has had a very strong recovery after the pandemic with 5.5% GDP growth in 2021 and 22. And 2023 also looks good. I mean, the outlook is quite positive. We started the year with very strong job market performance. And so Spain will probably be the fastest and strongest growing country in the EU among the large economies. And that's good news. Indeed, the inflation started to surge already in 2021. Luckily, last year, thanks to energy prices going down and also the many measures we took, we managed to bring it down 5 percentage points in 5 months. And Spain now has the lowest inflation rate in the EU. We must continue on that track.
Some of your coalition partners are suggesting perhaps you should limit the prices of some products. Is that something you're considering? Why not do that?
Well, we took measures end of December, which have kicked in January. They are already proving to be effective to bring food prices down. This is a top priority, obviously, because food prices affect the health and the well-being of families. And so we've provided support to the families, also support to most affected sectors by the energy price surge. And we need to see the development and the impact of these measures we took before taking other measures going forward. So far, I think we got it right to respond to the pandemic. We are also getting it right to respond to the impact of the crisis. And we should continue to take good measures without negative side effects.
So what's the biggest global risk that could put Spain's position at stake?
As I was saying, the outlook is relatively comfortable, positive, I would say, not comfortable, positive, even in this very complex international scenario, because we have very strong consumption growth, investment, also exports are performing extraordinarily, in particular non-tourism sector and services are performing very well. And we are also undertaking a massive investment and reform program, which is also modernizing our country, making it more greener, digital, having stronger sustainable growth going forward. So the outlook is relatively positive, and I think we need to continue to take the right measures and provide a European and a global response to global challenges.
The thing is, the Fed remains hawkish, and that could mean a stronger dollar. How are you assessing the risk from that?
I hope they get it right. I hope central bankers get it right on both sides of the Atlantic and throughout the world. They have to get it right so that they manage to cut down inflation without endangering growth more broadly, because sustainable growth is of the essence if we want to also prevent a financial crisis and support growth in most vulnerable countries. It all has to come together in a positive sense, like we did when responding to the pandemic.
Minister, thank you so much for that. Minister Nadia Calvino there. We're coming to you live from Bangalore at the G20 meeting for finance ministers and central bank governors. Anna, handing back to you.
Haslinda, thank you very much. Bloomberg's Haslinda Armin speaking with the Deputy Prime Minister of Spain. Coming up on this programme, we will talk about trading activity. The Hong Kong Exchange is finally seeing some relief. We'll discuss earnings with the CEO, Nicolas Aguzin. That conversation coming up shortly. And we'll also speak to Rebecca Minghella, founder and CEO of Clarity AI. We'll talk about the meeting point between that fast-growing, much hyped perhaps, technology, but also ESG goals. That conversation later this hour. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Surveillance, the early edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The value of the U.S. housing market has shrunk by the most since 2008. According to real estate brokerage Redfin, the total value of homes declined by $2.3 trillion with a T in the second half of 2022. That's a 4.9% drop. So the median U.S. home sale price was $383,000 last month, and that's down from a peak of $433,000 in May. That hurts. Meanwhile, Bloomberg's learned that Wells Fargo cut more than 500 employees in its mortgage unit this week. Wells Fargo also plans to shrink the portfolio of loans it services. That adds to thousands of job losses across the home lending industry, and this is a story that has been building. A huge winter storm is battering the central U.S. on the way to New England. Record amounts of snow are falling. By the time it's done, the Minneapolis area could get close to 1.5 feet, and hundreds of flights have been canceled already. More coming for sure. Meanwhile, the same system is bringing record warmth to the south of the United States. And British Prime Minister Rishi Sunak suggested he wants to do something the European Union has previously opposed. That is to make changes to the Brexit treaty. That would be part of a deal with the EU over post-Brexit trade negotiations and arrangements for Northern Ireland. The British government says the existing agreement hurts trade between the region and Great Britain. But of course, the previous government signed it, right? Or the previous government, or the previous government that signed it.
The previous version of the same government, I guess you'd say.
Yes.
Yeah, absolutely. So a lot of people focused on whether we get any clarity about this particular relationship and what that tells us about the broader relationship between the UK and the EU, and whether we see more investment coming into the UK if we get clarity on better times ahead in terms of that cross-channel relationship. We will talk about the Hong Kong exchange next, finally seeing some relief in the earnings story there. We will talk to the CEO. This is Bloomberg.
advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around US politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Federal Reserve is inclined toward more interest rate hikes to fight inflation. Still, minutes from the last meeting show almost all Fed officials want the pace of increases to slow down. The Hong Kong Exchange says earnings rose after 6 straight quarters of declining profits. We will be joined by the CEO, Nicolas Aguzin. And a push into artificial intelligence processors is helping NVIDIA. Shares are higher after the company comes out with a bullish outlook. I'm Anna Edwards in London with Matt Miller in New York. And Matt, clearly we've seen a lot of talk around the minutes and what the minutes told us, if anything new, given we've had a lot of data, hawkish data, since those minutes were put together from the last Fed meeting. And then there's the micro stories around tech earnings, in particular NVIDIA.
Yeah, I think those are two different stories, although, you know, it's interesting. The minutes seem to tell us that the Fed was on top of this lack of disinflation or the slowdown of inflation. So they were more hawkish than Powell at his press conference, but in line with the Fed speakers we've heard thus far. In terms of earnings, the NVIDIA results leading the market higher. You can see the S&P futures right now about 0.4%. We did have a big jump in yields, and right now we're up another 3 basis points, but still we're lower than we were at the peak of this jump. So that's less of a headwind for stocks. Right now, the 10-year yielding 394.49. In terms of oil, we're gaining again on WTI, 48 cents a barrel to 74.43. It's still lower than it was at this point 24 hours ago, but you have had oil just hanging around this zone lately as we wait for more data out of China to confirm whether or not that reopening is going to be reflationary, and then, or how reflationary it'll be. And then Bitcoin not moving very much at all, 24,292. Take a look at some of the pre-market movers. NVIDIA is one of the big ones, jumping after it gave what was really a bullish outlook in terms of its revenue after the bell yesterday, suggesting that a push into AI processors is helping to offset sluggish demand for PC chips. So, you know, they're on the AI bandwagon. It's serving them well. Investors are happy about it to the tune of 8% before the market opened. Lucid Group, on the other hand, the maker of EVs, plunging after posting worse than expected results, and the company's deliveries were much lower than anticipated. 1,932 sedans delivered in the fourth quarter. That was well short of the 2,831. That was the average of analysts' estimates. You know, they wanted to make 20,000 cars last year. Now they're expecting to make 10 to 14,000 this year. And then Meta, you can see it's not moving much right now, 0.5% in the pre-market. But watch after the Washington Post reported the Facebook owner plans to cut thousands of jobs. The WAPO cited people familiar on that story. Meta spokesman Andy Stone later said in a tweet that the Washington Post got this one wrong. Still, Zuckerberg has been talking up a boost in efficiency, and that may lead investors to believe that reporting. Anna, what do you see in Europe?
Yeah, we certainly saw that focus on efficiency really delivering for the Meta share price in just after we got that call from Zuckerberg. This is what we see in Europe then, to answer your question, Matt. European equity markets up by 0.1%, not by much. A real divergence across the European space, though, dependent on which markets you're focused on. The Stoxx 600 technology index goes higher. That's the NVIDIA effect in part, up by just over 1%, doing well for Germany then. Anglo-American weighing on the London market, down by 2.7%, and they were announcing into a market that's already been disappointed by mining companies this week. We heard from Rio and BHP, both of those disappointed. Anglo-American disappointing a little for different reasons, taking a big charge on one of their projects, a fertilizer project in the UK. That seems to be dominating the conversation there. And Rolls-Royce, this is the engine maker, and that company, the shares are up by 22%. The more their engines fly, the more maintenance money they earn, and so that is good for the business. But it's also the new CEO talking about a strategic change at the business, returning cash to shareholders. The new CEO has been 20 years or so at BP, and so there seems to be a lot of expectation about what can be delivered for shareholders there, Matt.
Yeah, very high expectations, look like, with a 22% gain. Fascinating stuff. Let's get to the business of trading shares. Hong Kong Exchange is finally seeing some relief after 6 straight quarters of sliding profits. The exchange reported an 11% increase in fourth quarter profit. It joins us now the CEO joins us now to talk more about the results in the trading environment. Nicholas Agazine joins us. Thank you so much. Great to have you on the program, Nicholas. Let me first ask you about, your results and really the outlook in terms of the trading picture. What do you expect for this quarter? What do you expect for this year in terms of volatility, turnover, just the broader trading environment?
Thank you, Matt. Good morning. Clearly, the numbers of the fourth quarter were good in the sense that it's our best fourth quarter ever. And to your question of what to expect going forward, the key variable that we're watching carefully is what's happening with the China reopening trade, in the sense that we've seen that has been much faster than expected. And so when we look at volumes, for example, in January, the average volumes were around 140 billion Hong Kong dollars per day, average daily traded volume. That compares with about 125 that we had throughout the year last year. So that slowed down a little bit in February, but what we're probably expecting is that it'll be moving, up and down a bit. But the natural trend is that investors are quite bullish on the fact that this reopening is going to generate quite a bit of growth from this part of the world. And many investors that had trimmed their position in the past, they're looking at perhaps catching up with the slightly shorter position that they had.
How quickly do you expect the reopening to accelerate, Nicholas? In this quarter, in this year, we're just hearing, I just heard a report this morning that the mask mandate has been extended in Hong Kong. I think I heard through March. Nonetheless, that doesn't seem to bode well if you're extending these kind of requirements. How does it look from your vantage point?
But Hong Kong is fully open at this point. I mean, there's a lot of visitors coming from all over the world. It's in some cases hard to get even hotels, and restaurants are like full. So what we're seeing is that Hong Kong is very active. Clearly, a lot of what's happening in Hong Kong is people are actually participating in a lot of what's going on in the overall China. And that's what's generating a lot of interest. We're also seeing a lot of people from China and also within Hong Kong going internationally to Middle East. I mean, I've been there a couple of times. I mean, throughout US, Europe. So there's a lot more connectivity. And we think that is really, really good for the role that we play, which is actually creating that connectivity between East and West. We're at the bridge. And Hong Kong historically has been known for its connectivity, for its liquidity, and the opportunities that we provide. Now, on top of that, we're adding new products, and we're having new diversification that we didn't have in the past. So more than the results itself, I'm excited about all the infrastructure.
Excited about the infrastructure, and are you excited about the IPO pipeline as well, Nicholas? That seems to have picked up at the same time as the China reopening story gathered momentum, and we've seen at the fourth quarter a little better on that front. What does the pipeline look like for this year?
Yes, you're absolutely right, Anna. The second half saw 4 times more IPOs than the first half. And even though it was a difficult year globally for equity fundraising, in Hong Kong, we had 90 IPOs. So 90 companies decided to list last year. In the first month of the year, which was January, already priced 10 IPOs. And for the rest of the year, we have somewhere around 90 that are already filed and are waiting to be approved. And there's a lot of interest in this new chapter that we are creating. It's called the Specialist Technology Chapter, which will address companies that have very little revenues but great value, great investment in research and development, etc.
Nicholas, can you tell us any more on the IPO front? Update us on your pursuit of the Saudi Aramco IPO, either the specifics around it or the guiding principles you're following as you push for that business.
The interesting thing, and I can't talk about individual cases, but let me tell you about companies in the Middle East, about companies around the world that may want to use Hong Kong as a fundraising hub. Hong Kong, as a result of recent changes in regulation, is the only market in the world where you can have capital raised and then you can eventually have investors, not only international investors, but also domestic investors from the mainland. And this is something very unique because in no other market in the world that you can have access to an uncorrelated investor base, both the onshore investors, and mostly retail investors that are very aggressive, but also all the international investors that obviously are located in Hong Kong. Hong Kong is a very international city with all the big houses from around the world. So it's the only market that can actually provide that. So we're seeing a lot of interest from international companies that are asking about, how do I do this? How do I play a role here? So very excited about that possibility.
You talk about the infrastructure, Nicholas, and I know you've been spearheading plans to strengthen your infrastructure so that you can trade through typhoons, through big rainstorms. You're not in that season, I think, until the summer, but when you do get there, typically the Hong Kong Exchange will close 5, 6, 7 times a year. Are you going to be able this year to go through that? Since everyone works from home now anyway, or can work from home, will we see no more typhoon holidays at the HKEX?
So I think you highlighted a good point. There's a lot of things that we've learned through COVID, people working from home. What we're saying is we want to be an international competitive market. We want to make sure that people can trade when the international markets are open. And how can we do this at the same time? We don't want to put anyone's life at risk during a typhoon or a heavy rain period. So we have to make sure that we're very thoughtful about the impact that that can have in the community and the people around. So we'll do it through a consultation. We'll interact with all the stakeholders. We just want to make sure that we continue progressing. We make this a first-class, market for everyone, and everyone continues to be safe.
Thanks so much for joining us, Nicholas. Nicholas Aguzin, the Hong Kong Exchange CEO. Coming up on the program, Rebecca Minghella joins us, founder and CEO of Clarity AI, where ESG themes meet with that hot new technology. We'll talk about that. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, there have been a lot of headlines recently about how artificial intelligence, AI, is reshaping the way that business operates, the way that all kinds of businesses operate. Joining us now is Rebecca Minghella, founder and CEO of Clarity AI, a sustainability technology platform. And Rebecca comes to us just from the London Stock Exchange, where you've been opening today's trading. So, Rebecca, welcome to the program. Thanks for joining us. So, sustainability and technology, your business sits at the sort of intersection of both of those. You use AI to help investors work out where to put their money, essentially. Are we getting much closer to defining exactly what sustainable investments look like? Because we still seem to be in the midst of those conversations.
Yeah, so, well, fortunately, we are getting closer to a better definition of sustainability. That's why regulations like the Sustainable Finance Disclosure Regulation, SFDR, is helping defining the sustainability so much better and helping investors to also label and their funds and make better disclosures. Today, as you said, we announced a very large partnership with the London Stock Exchange precisely to help investors define sustainability better and use better data and tools to make the sustainability assessment easier, right?
And in terms of some of that labeling, in Europe we have these different ESG fund classes, and we've seen, your research has shown that a lot of fund managers are suddenly pretty skeptical about Article 9 funds, which is the sort of top-rated ESG fund class. Why are we seeing that skepticism around those top ratings?
More than skepticism, what we see is that, well, to give some context, Article 9 and Article 8 are the definitions of the SFDR regulation in Europe to help investors disclose how sustainable the funds are. So Article 8 are what is called the light green funds, and Article 9 is dark green funds. So Article 9 is more strict of a definition of sustainability. And what we have seen in the last few months is that investors have been downgrading Article 9 funds, so the more strict sustainability definitions, to Article 8, which means that they see, or they are a bit more concerned about how they are disclosing sustainability, and they are trying to be more strict about how they define sustainability, right? Which is good news.
Rebecca, don't investors at this point still have to do pretty much all their own research when it comes to ESG? I was talking recently to someone who runs an ESG ETF, supposedly ESG, with big holdings of Exxon and Coca-Cola in it. It didn't make a lot of sense to me. So don't investors have to decide for themselves what they believe represents ESG?
I think that's a great question. There is some confusion in the market about what ESG really means, because it's a term that has been used too broadly and aggregating too many different concepts. So the first misconception to your question is, could an oil and gas company have a good ESG score, right? And the reality is that many of the ESG scores are based on a best-in-class classification, meaning that the best oil and gas company, according to certain sustainability criteria, could actually have a good ESG score. The other thing that is a misconception is that ESG is usually used more to assess risk linked to sustainability, more than actual sustainability or outcomes or impact. So again, that's why an oil and gas company with a lower risk linked to sustainability could also be performing well on ESG metrics, right?
What do you see in terms of growth, Rebecca, say for this year or next, in terms of the total industry? Because there's been such a backlash in anti-ESG, it's often termed anti-woke, backlash, at least here in the US, and I imagine it reverberates around the world.
Yes, I mean, there is definitely some backlash on ESG. The trend is clear. The volume of assets under management going into sustainability, sustainable investing keeps growing. So that's a reality. According to any metrics or any measures, it keeps growing. There is, of course, certain backlash in the US. I think partly it's understandable. I believe we should move away from politicizing the sustainable investing trend. I think we should all agree that in the long term, we all want a better society, a better planet. So I think trying to politicize this sustainable investing trend is not the right approach. But the most important thing is that what we want is, in any case, be able to provide data and tools so all the investors have more clarity, but not intended, on what the strategy that they want to follow, whatever the strategy is, right?
Yes, it certainly has a very political, specifically US political dimension, doesn't it, over there, which maybe hasn't translated entirely around the world. Let me ask you about the AI part of the business. I mean, you said it there, Clarity AI. AI is in the name, and clearly this is a hot topic right now. We saw it just overnight with the results from NVIDIA. ChatGPT is just everywhere. People talking about AI all over the place. Having it in the name, I mean, being a business that has been dealing in this kind of technology for a while, the fact that it's having such a moment, does that open doors for you more? Are doors opening more easily now than they were?
Definitely. So one of the ways, well, we use AI in several ways. One is natural language processing to make sure that we process information, capture data in a more scalable way. Also news, we process news much faster and in a much bigger scale than an analyst can do. We also use machine learning to do estimation models for CO2 emissions, and definitely any trend that is focusing on more adoption on any of those technologies, and therefore the excitement about our partnership with large financial platforms like the London Stock Exchange means that more and more these large platforms want to partner with smaller players like us that are more agile and more flexible, right, to be able to deliver those solutions and those new technologies, right?
Can AI help you to avoid pitfalls that we've seen recently with ESG problems involving greenwashing?
Definitely. So basically what it's helping with is data reliability. So analyzing data at the scale, checking the reliability of the data, being able to do a severity assessment as well, and again, everything at the scale with algorithms instead of using analysts. And at the same time, we of course avoid any biases that an analyst might have, right, on specific companies or investments.
Rebecca, thank you so much. Thanks for joining us. Rebecca Minghella of Clarity AI, and apologies for some of the background newsroom noise, but
sometimes people
we
sing.
coped with it. They do. It appears so. Coming up on the program, we'll run you through the market-moving events. I mean, I don't sing very often in the newsroom, but others do. Matt often sings. I can definitely confirm that. We'll look at the events that are coming up in your trading day ahead. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now a look at what is ahead today at 6 a.m. Eastern Time. We get the Turkish rate decision. Turkey may cut interest rates to the lowest in 7 years, adding a missing piece to its emergency response, perhaps, after the country's worst earthquake disaster in a century. At 8:30 a.m., we will get the second reading of U.S. GDP data, as well as initial jobless claims numbers. And a lot of people focus on those as a sort of real-time indicator on the labor market. Atlanta Fed President Raphael Bostic and San Francisco Fed President Mary Daly will both be speaking. After the bell, we will get earnings from Booking.com and also from Beyond Meat. And I know that you've been reflecting on the housing market, Matt.
Yeah, I have, because we had data out yesterday showing that prices have dropped 5% across the U.S., the biggest drop that we've seen since 2008. And it feels like there's just so much more to come, Anna, because if you look across, I mean, just anecdotally around this area, there's still seemingly unaffordable housing markets, especially with rates at the level that they are. So the worry is that prices have further to fall.
Yeah, absolutely. And our story points out that even with that drop, the total value of homes remains roughly $13 trillion higher than it was in February 2020, to your point about affordability. And that's really a focus here in the UK as well. Yes, we're focused on the extent to which prices might drop, and that is very much the conversation. But still, we see, even with small drops in places, we still see unaffordable homes. In fact, some people at Schroders crunching the numbers, Matt, and the house prices in the UK as unaffordable, or the last time they were this unaffordable, you have to go back to 1876. 18, that number starts with, to find a period. I don't know how you get the data, but there is data that goes back that far, which is impressive. I'm sure it's available on the Bloomberg terminal. That is it for the early edition. Surveillance is ahead with Tom, John, and Lisa. They'll be speaking to the co-CIO of Gabelli Funds. This is Bloomberg.
1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
What I'm following right now, also cash on the sidelines, money has to be put at work.
You're looking at an environment where the Fed does need to be tighter.
If I was them, I would pause and see what they've gotten done so far.
We do think that the economy will slow and will continue to slow from here.
I think that inflation can come down even if the economy doesn't land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Longest losing streak of the year on the S&P. Marginal losses in yesterday's session. Futures just about positive this morning. Good morning to you all.
The Federal Open Market Committee and the Board of Governors.
Are you reading the minutes now? Good.
I actually owe him an apology.
Oh, you do?
Yes, I owe Tom Keene an apology because yesterday I said the meeting minutes would be interesting, and maybe they massaged them, and they were not very interesting, and they weren't very nuanced. They felt kind of stale. So I just want to offer up an apology.
Let's get my single up just quickly. Let's restart the show. From New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio with Tom Keene, who's reading the minutes currently, alongside Lisa Abramowitz, who read them when they came out. I'm Jonathan Farrow. Futures up 0.4%.
Footnotes.
TK, I've got to say, those minutes were pretty bizarre for a lot of people.
Yes.
So Mohamed Al-Erian came out after the news conference, and he wrote a piece in the Financial Times, and he turned around and he said, and he counted, thank you, Mohamed, for doing that, disinflation was mentioned 11 times in that news conference. I think a lot of people went to Control F, had a quick search of that document for disinflation. It's not mentioned anywhere in the minutes.
It's a different story, and I think the overlay here, and we're going to get it with the second view of Q4 GDP, is it's all about inflation. It's all about that overlay, but this is an economy that just refuses to slow, and I wonder how people are adjusting their Q1 now. I mean, Powell in the minutes, they want the economy to slow. They want unemployment up. It's not happening.
I think it was Pantheon of Macroeconomics, Ian Shepardson over there, who said nobody at the Fed wants to stop hiking. And I think that's been a communication since the minutes, and arguably because of the data's just been so resilient.
So there are two things. Either these minutes were stale and they couldn't massage them enough to make them hawkish, really, truly hawkish, to change the market's perception. Or two, they were so dovish that they just stripped out disinflation and they were left with something where basically people were still willing to hike. These are the kinds of discussions, basically people were primed for some sort of hawkishness stemming from these meeting minutes. But, you know, what can they do with the sort of feeling that they had before of disinflation?
It was a strange performance from Chairman Powell in that news conference. I think we all felt that at the time, didn't we?
We did, and then he said, read the minutes, and we read the minutes, and it was like, okay. Did you read this part about financial conditions? It was like, they're there.
Well, hang on a minute.
I thought of you, John. Thank you. I thought of you.
When he said read the minutes, it was in response to a question about whether they had discussed a pause. So like we read the minutes, and there's no discussion of a pause. It was weird. Let's move on. Futures look like this on the S&P, positive 0.5% on the S&P 500, trying to bounce from the longest losing streak of the year so far. We're down about 4 days over the last 4 days on the S&P. We're positive this morning. Yields are up again. Got to talk about it, Tom. Up another 2 basis points, approaching 395 on a 10-year.
Yeah, the 395 on the 10-year to 396, and of course on the watch for 4% there. And what's important here is you continue to see some form of yield curve lift, which I think, again, goes to the idea of some form of persistent disinflation. And what's unspoken here is the growthiness that everyone's been wrong on.
Hello, 105 on euro dollar. That's a change.
Yes.
Back to 105 for the first time in the last 24 hours, Lisa, since the first week of this year.
As people bring forward the potential for more Fed rate hikes. Interesting that just a couple weeks ago when you were asking John about the prospect for Europe, for ECB to raise rates more than the Fed, everyone said yes, and yet here we are. Perhaps it's all priced in. Here's what we're looking at today. 8:30 a.m. we get U.S. initial jobless claims as well as the second print of the fourth quarter GDP. Initial jobless claims. It has just been shocking to see them flatline, basically. People are not filing for unemployment benefits. And you can make a lot of technical arguments for this, but the labor market still is tight. And what we're looking at right now is the margin compression in companies that are dealing with a tight labor market and forced to pay up. And that is a persistent trend that's going to be a really big issue for this Federal Reserve. At 12 p.m., U.S. Commerce Secretary Gina Raimondo is delivering a speech about the CHIPS Act, as well as a longer-term vision for technological leadership of the U.S. I'm curious what she has to say about TikTok, about some of these other issues, about what we see with respect to China giving sort of a little bit more dominance over certain aspects of the technological sphere, and how much that plays into some sort of look forward. Today, we also get a host of Fed speak, including Atlanta Fed President Raphael Bostic at 10:50 a.m. and San Francisco's Fed's Mary Daly at 2 p.m. What more can they say? John, I mean, honestly, every single person is basically saying we're going to get back to 2%, like John Williams said last night. We're going to keep going. What more are we looking for? I mean, honestly, I'm kind of at a loss because they can't tell us anything that we don't know, and the data is what it is, and it is very unclear.
March 10th, payrolls. Lisa, thanks for that. March 10th payrolls, Tom. That's what we're waiting for. Will that confirm the boom we saw in January? Will we have a similar backdrop for the labor market in February?
And then on to the CPI report. We don't have time now to go into it, but across the show today, we've got to talk about the disinflation crew, including the conversation yesterday with Ed Hyman, Citigroup, writing out of London in the last 24 hours on true disinflation in the United Kingdom. These are lonely voices.
Let's pick up on the year-to-date moves. We pulled back just a little bit. Year-to-date on the S&P, up around 4%. On the NASDAQ, up close to 10%. Consumer discretionary year-to-date is up 13% on the S&P. That's a run. To talk about it, here's Chris Marangi, co-CIO at Gabelli Funds. Chris, wonderful to catch up. Can we just start with something broad? What about the rally so far year-to-date? And I understand that recently we've pulled back, but what about the rally so far year-to-date do you think is going to be a little bit more durable than some people think?
I think for the year, the market doesn't do a whole lot. Obviously, we came into the year off a very difficult 2022. We saw a very typical January effect with most of the big losers up the most. And then we saw, obviously, some better inflation data, which got people thinking about what could go right, whether that's a pivot, a soft landing, China reopening, et cetera. And then more recently, we're refocused on rates staying higher for longer. And I think that's the question. It's not so much what's the terminal rate, but how long do we stay there? And obviously, that's caused people to rethink some of their earnings outlooks, rethink the discounts on stocks, and led to this little bit of a pullback.
Chris, to the Gabelli Equity Trust, and this is one of my themes for this year as active managers scramble, you have a legitimate active managed portfolio. GAB, and folks, full disclosure, years ago, I owned a truckload of this. GAB has an R-squared of 0.495. We have active managers that look like index funds. Is this a year for active management, or is this a year for the pseudo-active managers that have R-squareds of 0.99?
Well, for years, obviously, we've been saying active management still works, and this could be the year that we actually do see some real alpha generation. Like when you look at the indices, obviously heavily weighted towards some of the big tech-driven companies and the issues that they have, many of them idiosyncratic. I think there really is an opportunity for active managers to outperform by really doing the work on individual stocks and figuring out how this new world is going to impact them.
John reads Barron's at 6 a.m. every Saturday morning. He sits down at the coffee table with a tea, not coffee. He has tea, Chris, and he reads Barron's cover to cover. Mario's in there, you're in there. Which sectors, which stocks are part of that active management for this year?
Well, certainly, we are bottom up and focus on a select group of industries. One of our core competencies is in media and telecom. Is the worst sector. Communication services down 40% last year. A lot of that was driven by Google and Meta.
Okay, give me a name. I mean, no one's watching, Chris. Come on, give me a name here in media and telecom, flat on the back. Who is it?
So, well, up year to date a lot, but still very cheap. Warner Brothers Discovery, which reports after the close, and Paramount, two of the old media companies that have been in the midst of massive transitions from the old model of dual revenue stream advertising and subscription to this direct-to-consumer. And there's a lot of pain that's happened. There's probably still more pain to come, but we're on a path to rationalization of those costs and eventually some sustainable profits.
When you're deciding which companies to buy, which seem appealing to you, how much are you looking at the size of their workforce and whether or not they have what to cut or whether they have to be raising wages like what we saw from Home Depot and Walmart?
Well, nirvana for us is companies that have pricing power, that can pass along price, but they can leverage costs, that have very fixed cost bases. You think about some of the waste companies, some of the broadband companies. It doesn't cost really any more to send more bits over their wires now than it did a few years ago. But when we look at some of the big tech companies, for example, they overhired clearly, and they have a lot of room to cut and a lot of room to support margins as advertising decelerates and continues to come down. So certainly a factor we'd look at.
Does that make big tech appealing?
We have not been big owners of Meta and Google historically. We do own some of them. They look statistically cheap today. Again, more pain to come in the ad market. There's some secular issues that have to be sorted out around AI, et cetera. I think that's mostly noise. But yeah, they look pretty interesting today.
Hey, Chris, this was great. It always is. Chris Maranghi there of Gabelli Funds. Chris, thank you, sir. TK, too close to the truth. The good people at Dow Jones. It's Barron's and the Wall Street Journal on a Saturday morning with a mug of tea, lemon and ginger.
I was about to say, what kind? Lemon?
In front of the football. So read through the papers, flick through them, and
I come over, I bring the dogs, I bring Vet Bill and Kennel Fee over, and
there's no way he would let you bring Vet Bill and Kennel Fee after we told them about what they did to your Christmas tree. Just saying.
That's true, but we go over.
When we lived in the same building, he was never allowed to come down to mine.
I am absolutely
always went up to his.
That's absolutely not surprising.
Because he made a mess.
What he said there about Meta was interesting, because he basically was trying to say, yeah, they haven't technically liked these, but it's more interesting that it has been in years, and this comes after there was an announcement of more layoffs, even more after saying that they were pretty much done in November.
I can't say enough about Mario Gabelli's heritage in securities analysis and in media, John. Warner Brothers Discovery, what a train wreck. Off the enthusiasms of a year and a half ago, down 62%. It's bounced up 66%. You know the math on that. To get back to where it was, it's got to go up another 62% from here. That's what Gabelli's betting on.
The Paramount year-to-date up 38%. The Walt Disney Company year-to-date up 17%. And to your point, Tom, they had such ugly years. The likes of Warner Brothers.
I deal with Paul Sweeney every day at 9 o'clock worldwide on radio, and Paul's expert on this.
I think, Tom,
he says,
I think Paul deals with you.
Well, there's that as well.
The framing's important. Framing's important here.
Exactly. Paul Sweeney just says he's never seen this. Where's the profit? That's all it comes down to.
Well, they were chasing the growth, weren't they?
Yeah.
The questions changed. Wouldn't you say that? The questions changed? Especially when it comes to streaming over at Disney, it was all about chasing growth, chasing subscribers, and now it's about where's the profit.
And they're making tough strategic decisions on HBO and other things. When's the consolidation happen? And it's great to talk to Maranghi about that. They're courageous.
This was great. Julian Emmanuel joining us in the next hour from Evercore ISI. Looking forward to that. To build on the work from Ed Hyman of Evercore yesterday. Listen to that. Great conversation, guys.
We did okay.
Ed was brilliant. It was fantastic. I told you I'd listen to that.
Yeah.
He was great. Don't ask me what he said. Futures up by 0.5% on S&P.
Don't worry. I'm just basically shooting this.
Don't test me. Don't test me. I've forgotten everything from yesterday. You was up 3 basis points on a 10-year. Let's call it 395. Equities up. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Core inflation in the Eurozone set a record last month. That probably cements the European Central Bank's plan to raise interest rates by another percentage point in March. Now, core prices gains reached 5.3% in January. Headline inflation, which includes food and power, was up to 8.6%. The minutes from the latest Fed policymakers meeting shows that the central bank is inclined toward more interest rate hikes to curb inflation. Still, almost all officials back slowing the pace of increases. The market indicates that 25 basis point hikes are likely coming in the March, May, and June meetings. President Joe Biden says Vladimir Putin has made the world less safe by suspending participation in the new START nuclear treaty. Still, he told ABC News he doesn't believe that means Russia will use nuclear weapons. The treaty seeks to limit the deployment of intercontinental range nuclear weapons. India is hosting the G20 finance chiefs meeting this week. Now, Bloomberg's learned that officials there want to avoid the use of the word war in any joint statement referring to Russia's attack on Ukraine. Instead, the word crisis would be more acceptable. That would be a change from the consensus reached by the G20 leaders last November. And shares of NVIDIA are higher in pre-market trading. The company came out with a bullish revenue outlook suggesting that its push into artificial intelligence computing chips is paying off. NVIDIA also announced it's starting its own AI cloud service. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today, the global spotlight is on India as the G20 financial leaders gather. Among the issues on the table, debt relief, inflation, climate sustainability, and more. Live coverage continues on Bloomberg, your global business authority.
I've not seen anything, we've not seen anything where there's a change in this posture, what they're doing. The idea that somehow this means they're thinking of using nuclear weapons, international continental ballistic missile, there's no evidence of that.
The President of the United States, Joe Biden, there on ABC in the last 24 hours. From New York City, let's get you some price action briefly. In your equity market on the S&P 500, we look a little something like this, up 0.4%. Equities up by 15 points on the S&P. Their four-day losing streak on the last 4 days. That's the longest losing streak of the year so far. In the bond market, yields approaching new highs for the year again, just short of 395 at the moment, 394.49, up 3 basis points. And that dollar strength, we just slowly keep milking out some dollar strength. Euro dollar, 105.93 in the last 24 hours. Had a look at a 105 handle for the first time since the start of the year. We're negative there by about 1/10%. Had some CPI data out of the Eurozone a little bit earlier this morning. You can now include the German CPI data in all of that.
What is it?
5.3%, up from the initial read of 5.2. So that's the final read on CPI in the Eurozone. Headline ticks up to 8.6%. So they've got a problem on the core read, haven't they? And ultimately, the ECB is going to have to do more. You'll get some Fed speak a little bit later. We had some BOE speak, is that a thing? We're going to call it that?
Of course, sure.
Some
You're
Bank
the
of England
expert.
talk from Catherine Mann, good friend of this program over the years, Tom. I believe that more tightening is needed, and caution that a pivot is not imminent.
This
That's
is
from the
really,
hawk on the MPC.
Really, really important. This is someone who's not only once but twice truly expert in international economics. Catherine Mann is absolutely associated with the U.S.-China dysfunction, as she's put it, in codependency. And you wonder what the codependency here in the continent of Europe is with the Bank of England as they sustain inflation. My answer is everybody's going to extend out their x-axis. Transitory is going to become even less transitory.
Oh, they're pushing it out, for sure.
Even if you get Hyman disinflation, you're still going to push out a blended inflation rate in other economies.
We came into 23 in the same way that we came into 23 with Europe, discussing the potential for recession in the UK. Now we're talking about skirting it. And how many people lined up to throw mud at the British economy in the last few months? And now there's a real conversation about maybe escaping that downturn, Tom.
At least it's the growthiness that's out there that we're going to see in second view, fourth quarter today.
Although you have to wonder whether this is just delayed because of the lag effects, which I know you love talking about the lag effects.
Long and variable.
Long and variable.
Just
lags.
much longer than some people.
I've never been a fan. Never a fan.
Super long.
Right now, what we're going to do here is we look back 364 days to speak with Mark Champion, our international affairs senior reporter for Bloomberg News and truly expert on synthesizing all of these emotions and realities for the continent of Europe. Mark, Max Seddon and the team over at the FT today write up a big take, and they talk about Ukraine, and they really talk about Putin. It's heavily reported, and one of their sources says of Mr. Lavrov, I quote, Putin has 3 advisors, this according to Lavrov, Ivan the Terrible, Peter the Great, and Catherine the Great. Okay, that's Putin looking back to the past to rationalize what he's doing. What does Putin see in the present?
That's a really good question. So if you listened carefully to his speech the other day, he kind of began and ended on this idea of history, that these are our historic lands that we are gathering back now. And it is really important, and I think we all, including policymakers in the West, overlooked how much he was becoming obsessed by history, really. And in 2021, in the middle of 2021, he wrote 6,000 words in an essay about Ukraine and about its history. And it's a pretty skewed version of history, but he believes it. He sent that document out with the troops. They had, officers had it in their hands when they went to fight. So, the present for him is the past in a lot of ways.
Do we have a Ukraine that can attack right now? I understand there's horrific wars, and the news flow, Mark, in Washington and New York has been just appalling about a trench warfare almost. I'm using that as an amateur. Does Ukraine have the ability to attack?
At the moment, they are really just trying to survive a Russian attack, and they don't really quite understand yet how much the Russians will be able to bring to bear that they haven't already. But the Russians have just been sort of ramping up in all the areas where they've been fighting for several months along the Eastern Front. And they're just ramping up, putting more and more pressure on the Ukrainians. And the Ukrainian strategy at the moment is really to just try and let the Russians come at them, grind down, exhaust their troops. This worked for them last summer. It was very difficult for the Ukrainians. They lost a lot of people too. But by the time the Russians had gained a few towns at the end of the summer in the Donbass region, it left them undermanned, exposed, and the Ukrainians were able to counterattack. And I think that is the plan for the Ukrainians now. They're talking about the spring, once they've got the tanks from the west. The first of those, the Brits say that there's their few tanks, Challenger tanks, will arrive in a few weeks' time. So that these things will start appearing, the Bradleys, the Marders from Germany. And these are pieces of equipment that allow a maneuver offense. So you can get out of the trenches, you can start to get your people into armored vehicles and move if you can break through. At the moment, even if they were able to break through, they probably wouldn't be able to sustain that. So the hope is that, A, they'll be able to wear down the Russians as the Russians attack, and B, they'll be able to move.
Does China's involvement, China's potential aid to Russia, change the scenario at all for Russia?
It would be absolutely dramatic if it happened. So if the Chinese were to start supplying, arms at a high level to Russia, that would change. It would really change everything on the ground. It would be very difficult, really, to be honest, to understand then how the Ukrainians would be able to break through, simply because the Russians would have everything that they needed.
Yeah.
They'd also have long-range precision missiles to, constantly take out Ukrainian logistics behind the lines. So that would be a game changer, yes.
We've been hearing from the administration in the United States about the potential to release some of their evidence to make the case that China truly is seriously considering supplying ammunition to Russia. Who would the U.S. be talking to by releasing those documents?
I think, I think primarily the Chinese. I think what the Americans had some success, really, at the beginning of the war, where they put it out into the public all the intelligence that they had about the fact that they believed that the Russians were gearing up to invade. And the audience there was very much the Russians. They were saying, well, it was also the Ukrainians and the West to sort of prepare them, but they wanted the Russians to understand that that they knew this was coming. They wanted to be able to get out there and say there will be serious consequences. It didn't work. And I think really with the Chinese, it will be the same. They'll be trying to say, look, we know what's, you may be deciding you want to do, and just be aware that we know, and be aware that there will be consequences.
Hey, Mark, thank you, sir. As always, Mark Champion of Bloomberg out of London. This has got to be the #1 issue on our radar right here, right now. Ned Price, the State Department spokesperson, was speaking yesterday afternoon, and he said the following: "We have not yet seen the PRC provide Russia with lethal aid, but we don't believe they're taken it off the table either. We're concerned. We're monitoring very vigilantly for potential violations." Lisa, right to bring this up, Tom. It is a big, big issue going forward.
It's a huge issue going forward, and I think it is part of the financial and markets uncertainty out there. We like to keep the war separate. It's not. It's not in Europe. It's not here. And the unknown, Al Arian's expert at this, the unknown unknowns here are tangible.
You end up in a proxy war with China?
Well, yeah.
I think that's something you can just
I'm sorry,
ignore.
the footage, let's review it. The footage yesterday of the gentleman from China directly across a table playing, they could be playing bridge or gin rummy with Vladimir Putin. Compare that to Putin and Lavrov a year ago,
I remember that,
like with a big long table.
Futures right now, up a third of 1%. Coming up, Michael Pond of Barclays. That's next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
The equity market trying to bounce this morning. Good morning to you. Equity futures up on the S&P 500, just marginally by 1/3%. On the Nasdaq, up by 3/4%. Over the previous 4 days, the S&P 500 down about 3.8%. A 4-day losing streak for the benchmark here in the United States. In the bond market, 2-year yields approaching the highs of the year on a closing basis. Remember, just a couple of days ago, 472.26, the new closing high on a 2-year yield for this hiking cycle. Right now, 470.36, so just short of that and just short of levels we haven't seen since 2007. In the 10-year portion of this market, your 10-year note up a couple of basis points as well this morning to 394.10. The 30-year 393.18. This curve has got kinks right the way through it. Look out for the BOJ March 10th. Don't forget this. Keep an eye on what's happening in the JGB market. We're getting very close to and breaching sometimes through this week that 50 basis points threshold on a 10-year for yield curve control. So that's something else to watch in the bond market. I'll finish on foreign exchange. Euro dollar taking shape as follows. Eurozone CPI core comes in at a record high. Euro dollar 105.93, negative 0.1%. The ECB facing down an economy that might escape recession, but inflation that needs more rate hikes. According to many officials, they're set to go another 50 basis points. We heard from the Fed yesterday, minutes showing more rate hikes on the horizon. The committee writing the following. Prepare for the Fed speak, Tom. Participants observed that a restrictive policy stance would need to be maintained until the incoming data provide confidence. Now, you didn't. That inflation was on a sustained downward path to 2%, which was likely to take some time. In the wake of recent upside inflation data. After that, we heard from the New York Fed President John Williams, reaffirming a commitment to 2%.
Price stability is, in fact, the foundation of economic prosperity. Without price stability, all of the other goals that we have, whether maximum employment or low and stable or low interest rates, can't be accomplished. So that's an absolute imperative for us.
That's the goal, TK. Can they achieve it without causing a ton of economic pain?
For the mere mortals of us, unlike Olivier Blanchard and Kenneth Rogoff, they disagree. Olivier Blanchard feels there's a tendency towards a John Williams lower R-starred, and Professor Rogoff said he's not so sure with respect to his colleague Olivier Blanchard, but Professor Rogoff says maybe we will be removed from that 2% level.
Alarian in Rogoff's camp thinks it could be stickier than some people think.
This is what makes a parlor game up, and there's people that are in the trenches that have to sort this out, and one of them, and truly, truly expert, is Michael Pond, himself an institution at the institution known as Barclays, head of global inflation-linked research. Michael, I want you to take your expertise in price change and how it's seen in the market. And folks, just to give you an idea of the Greek that Michael Pond, I'm going to read this out for radio. Bring this up, Amy, if you would here. And this is Michael Pond in his research note. He's long the TII February 50s versus the TII February 53s. I have no idea what that is, folks, and we'll leave that to Barclays to make the fees to support Mr. Pond. Michael, if we get Ed Hyman disinflation in the United States. And Benjamin Nabarro at a small bank Citigroup writing up UK disinflation today. If we get an abrupt disinflation, what does it do to your bond world?
Well, I think what's really interesting in the bond market right now is that there seems to be different stories when you look at real yields and when you look at inflation expectations as priced through TIPS or CPI swaps. So the bond market is priced for that Ed Hyman disinflationary world, where if we look beyond the next couple of quarters, the market's basically priced for the Fed to be hitting their targets all the way into perpetuity. And yet real yields are quite elevated all the way out the curve as well. So we have the combination of the market pricing and relatively low inflation, but also relatively tight monetary policy. We don't think those things can exist for very long. Clearly, right now, the Fed is hawkish, and they are likely to continue to tighten monetary policy. We don't doubt their credibility on that. But if they achieve their inflation goal, then real yields are too high, especially on a structural basis.
How do you play this for mere mortals? Do you buy duration and take a bet out 7 years or 10 years out? I mean, how do you play it away from Michael Pond Greek?
We think it's tough to do just straight through nominals. And in fact, we think it makes more sense to pit one against the other. In other words, either break evens are right and inflation's going to come down, and therefore the Fed beyond this year needs to be quite a bit easier than the market's priced. Or if real yields are priced correctly and the Fed is going to remain that hawkish, it's probably because inflation is much higher than where the market is priced. So we think it makes sense to basically be long both break-evens and real yields.
Is it good or bad for the Fed that the market believes in it? I mean, honestly, on one hand, it gives it the signal that perhaps inflation expectations aren't becoming unmoored. On the other hand, it creates easier financial conditions that muddy their transmission mechanism.
Well, first of all, I'd say finally, ever since Jackson Hole, where Fed Chair Powell came out with his speech of keeping at it, echoing Volcker, saying that they're going to keep at it until they get their 2% target on inflation. The market didn't want to listen to them. The market kept wanting to hear that dovish pivot. But with the data that's coming in, it's just hard to fight that Fed mantra of hawkishness, persistence. And so finally the market's listening, and that does help out the Fed, because one of the things that's been working against the Fed for most of this year is financial conditions. So with equity markets roaring, with bond markets rallying, that works against what the Fed is doing. So right now the markets are doing a little bit of the heavy lifting for the Fed.
Michael, you said that you're long both real yields as well as the inflation expectations and where they are right now. How does that play into the view of things that we've heard from Mohamed El-Erian, from Adam Posen, from many others, that perhaps this Fed is going to have to allow inflation to be a bit stickier and a little bit higher than they'd like?
Well, it depends. You know, it's a difficult situation here because the Fed will lose credibility if they let inflation linger too high for too long and signal that they're comfortable with that. And therefore, it will be much more difficult for inflation to come back down to 2 if inflation expectations start to become disanchored. So we think that's not a great strategy, and we don't think it's likely at this point.
Michael, the idea of inflation here, and of course it's talked in economic babble, and the idea is core versus top-line inflation. When you look at the economics out there, including Barclay's world-class economics, which do you look at more? Or is there a different series you look at?
Well, Tom, we look at everything. We slice and dice inflation across different metrics as much as we can. The Fed, while their target is on headline PCE, they have tended to focus, as the market, on core inflation measures because core tends to be a better predictor of where core is headed, and monetary policy works with long and variable lags. So you can't react to where inflation's been. You need to think about where it's going. The Fed right now is focused more on core services ex housing. So really slicing and dicing. But the main message there is that they're not worried about inflation any metrics anymore. They're worried about the labor market.
Right.
If the labor market remains strong, their Phillips curve models tell them that inflation will remain strong, and that's what they need to focus on.
What's your 10-year yield, nominal yield, the vanilla 10-year yield? Michael, I know you never do this. I'm wasting your time, but Michael Pond and where the 10-year yield is at year end.
Just for you, Tom, I'll take that. I'll take that. We think it does go down to 3.5%. We think that eventually the Fed hiking will take hold on the economy. The economy is remaining quite strong here, but we think the Fed continues to hike, the economy slows, and bond yields come down mostly through real yields through the end of the year to 3.5%.
Michael, a lot of people are looking at the mess of information. They've been talking about the shattered disinflationary dreams. Is there anything that we've already seen that makes you question the faith that we're going to see 10-year yields go down further and that the market is right to expect the Fed achieves their goal?
Well, I think any inflation forecaster that's being honest needs to be humble. We think there's considerable uncertainty in the outlook. So take rents, which make up 40% of core CPI between rents and the owner's equivalent rent. We think that based on private series that are coming in very soft, that by the end of the year, that portion of CPI, that 40% of core CPI slows quite dramatically. But right now it hasn't. And it's been sticky to the upside, and that tends to trend. So it may take longer for that to come down than we in the markets expect. And that, we believe, will keep the Fed on a hawkish path for now.
Hey, Michael, this was great to listen to. Thank you, sir. Michael Pond there of Barclays. Shattering disinflationary dreams. I love that. Did you come up with that on the spot? That's just brilliant.
Yeah.
Got a lot of time for that. Do you want to see some deflation? Here it is.
Please.
Real estate brokerage Redfin coming out with house prices. After peaking at $47.7 trillion in June, the total value of U.S. homes declined by $2.3 trillion, or 4.9% in the second half of 2020.